recording. All right. Okay, so learning objectives for this, this particular chapter here. We're going to talk about pre-closing procedures, including due diligence. Love the due diligence process. That's my friend. And then we're also going to talk about the TRID requirements. So we talked a little bit about TRID last week when we were talking about financing stuff. And so now we're really going to get into talking a little bit more about TRID and all the rest of things and how the closing disclosures have to go and how the loan estimates have to go and kind of what the time frame is for all of that. Then we're going to calculate more math. Yay, math, right? Somebody put on my last course evaluation, she really likes math. Well, I don't mind the math at all, but I find that so many people are afraid of the math. I try to be a cheerleader for the math. You know, you can do the math. The math is going to be fun. We're going to have a good time with math. Just maybe to kind of help you not to feel quite so intimidated about the math. So, because the math is how you figure out your money. And so that's what's important. But we'll be looking at lots of things here. Prorations, we'll revisit loan to value. That's going to be with us forever. Interest, interim interest, escrows, credits and debits. When does the buyer get the credit? When does the seller get the credit? And who gets the debits? Okay, so we're going to be doing a lot of that. Okay, so here is like the road to closing. So we go from the signed contract. All right, we change our status on the MLS. The escrow deposit goes to the closing agent. The loan application, title insurance is ordered. We get the appraisal. We've got contingency. We've got loan approval. We've ordered the pest inspection. We're negotiating our repairs. The work's completed. It's approved. We get the survey. We get property insurance. Insurance policies going to the closing agent. The buyer and the seller set the closing date. There's pre-closing inspection, closing documents to the buyer and the seller. The buyer gives the amount, the signed closing documents received, the transaction checks are delivered. You pick up your lockbox, you send a letter of thanks, and then you start it all over again. And I kind of talk that this is not like on the test because it's not necessarily in that particular, order every single time. But what could possibly go wrong, right? Lots of things can go wrong. Lots of things can go wrong. Loan applications. I mean, like kind of what Jennifer was mentioning. People that started this process right when the virus hit, all of a sudden the requirements for loans changed. They changed. And so people that thought they were going to get a loan might not have gotten a loan. That's something that could go wrong. Okay. You could have a last minute appraisal issue. That could go wrong. You could have a last minute hurricane, tornado. That could go wrong. Okay. You could have a seller that didn't want to do some really logical, reasonable repairs. That could go wrong. Lots of things can happen. And so this is where you really earn your money, I think. It's great to go get a listing and that's fine. And you put it on the MLS and then your work is done. All right. Because people are out showing the house. Everybody wants to, if that's a house that fits some people's criteria, you're going to have lots of people showing that house for you, trying, kind of helping you get that house sold. If you're on the buyer side, you're just there helping your client, find something that they like. And you're looking at a lot of different properties and talking about pros and cons with them. And it's really fun. Once you go under contract, that's when you really start to earn your money because you're keeping everybody informed. You're keeping your client informed. You're keeping the other agent informed. You're keeping attorneys informed. You're helping your client make sure they don't forget to get their utilities turned on, that they get their insurance, that, what's the inspection doing? Then you got to help negotiate repairs. And what if the other side's a jerk? And that's when you really earn your money is during this particular process. From the time you go under contract until you actually get that check in your hand. All right, that's where your expertise really starts to come into play.
This might be jumping ahead, but just with everything you just mentioned, when it comes to doing that part, do you kind of recommend you only do so many in a time period? You know what I mean? I guess that's hard to say because I know closings could be any time, but you know, how many homes you're closing at once? You know what I mean? How many can you really do?
Yeah, well, if you get to the point that you have too many, hallelujah, hire an assistant. That's what you want.
Gotcha.
That's what
Okay.
you want. You want to be so busy, you've got to hire an assistant to help you maintain everything, right?
Okay.
And
Right.
I'm actually an assistant to someone who was that busy and hopes to be that busy again soon. And I'm his closing coordinator. And I'll be doing these things. It's a great deal for him. It helps him do more closings. It's a great deal for me because it's a way that I can focus on, well, one, things that I'm pretty good at, things that really relate to what I teach. And it also helps me be able to stay very involved in the business and not be neglecting a client. Because now, see, like I have somebody that I got on floor duty on Wednesday. They want to look at lots or maybe a house. They're going to be moving up here in the next year or two, and they want to go ahead and take their time and be and find exactly what they want. It may be a lot they're going to build, or it may be a house. They're not quite sure, and they're like, "Well, maybe we could come up next weekend." And I said, "Oh, I'm so sorry. I'm got this coronavirus thing going on, and I'm teaching online for the next 3 weekends. But after Memorial Day, I'm good. So I had to tell them, I can't go help you look at property on the weekend because I'm teaching. So that always makes me feel guilty. So that closing coordinator role is a good one for me. And also teaming is a good thing for me. And you talk a lot more about how teams form and things like that in post, so you can really understand that. But yeah, your goal is to have so many that you need an assistant.
Okay. Thank you.
Mm-hmm. So in pre-closing, all right, what is closing? Closing is when all those things that are outlined in the contracts that we've looked at actually come to fruition. Mortgage funds, if any, because it may be a cash closing, are distributed to whomever it needs to be distributed to, right? To the buyer for their use to pay off whatever it is they need to pay off. Other settlement costs or funds are dispersed. Title to real estate is transferred by the deed in exchange for the payment of the purchase price. So you give them the money, they give you the deed. And that's just kind of, in summation, what's going on in the closing process. So the buyer's due diligence, all the things that happen in the buyer's due diligence process. They get their loan, they make sure they can get insurance, and that's where, Matthew can come in. And they really need to check out the insurance first thing. Because, you don't want to wait. For example, here's an example. You don't want to almost forget that and have to call your agent like the day before closing and go, "Oh crap, I've got to get homeowner's insurance on my house." And go, "Okay, let's take a look at it." And then you think you have everything. Then they call you the morning of closing and go, "Oh, guess what? We can't insure that because it's a log home. And we don't do log homes. You've got to get somebody special." Then you got to go find somebody that'll do log homes at the last minute. So you don't want that to happen to your client. So you want to have them, go ahead and check that out first thing. They're going to get the inspection. They're going to get an inspection. And the inspection is the first thing that you do. And you want to get the whole house inspected. You want to get a wood destroying insect inspection. That's termites and carpenter bees and things like that. All right, you want to get that. You want to get a radon inspection. So you want to make sure when the inspections that they're getting all the different types of inspections that they need. Okay. Probably the bank's gonna, if they're getting a loan, they'll have to have an appraisal. I highly recommend that you tell them to get a survey. Many times those aren't required anymore. And if it is a subdivision where there are, plats and lots and blocks, you probably don't need one, right? Unless it's been like a long time since that's been done, you may want to have it updated. But if it's anything else, a survey is pretty much a good way to make sure there's no encroachments or anything like that. You have to remember, because if it's on septic, the bedrooms must match the septic report. The number of bedrooms must match that. And so you probably want to get, if they have septic, I highly recommend that your client get a septic inspection. Once you get all your inspections and everything's figured out, then you negotiate all of those improvements. Okay? And of course, you have the right to terminate at any point before the end of the due diligence period. Okay? And you have the right to go on the property as much as needed in order to be able to do all of these different inspections. Right? So it's okay for you to go for the inspection. It's okay for you to go for the termite inspection. It's okay for the insurance people to go. It's okay for you to be there for the septic inspection. You know, the seller has to give you access for all of these different inspections. Okay. Now, we're not going to talk about the changes due to the coronavirus in some of this process because that is not on the test. And I do not want to get you confused with what's going on in the real world right now and what you're going to need to know on the test. Once you pass the test, okay, we'll probably be in phase 2. Let's all say a prayer that we are. Things are going that well that we can be in phase 2. All right. And then things will be changing. But your office, your BIC, you know, there will be detailed directions as to what you do and how you do it as we go through every single step of the recovery. So don't worry about how it actually works in the real world right now. Just worry about what normally happens because that's what they're testing you on. So remember that the buyer can terminate at any point during that due diligence period. Okay, for any reason or for no reason. They don't have to give a reason. Okay, they can just say, change my mind. They don't even have to tell. All they can do, they just terminate. There's a form that you fill out for the termination. It must be submitted in writing to the seller and the seller's agent before 5 p.m. on the due diligence period expiration date. Okay? That's when you go from that unilateral to that bilateral contract. Okay? Once you get over the due diligence period, you're no longer unilateral, you are now bilateral. And I've had that happen before. I was negotiating with the sellers. They were jerks. And we didn't think they were going to extend the due diligence period for 5 days so that we could finish the negotiations. So we sent them a termination acknowledgement. We sent them that form. And then they decided, they signed the extension of 5 days. And then they were still jerks. And what ended up happening is the seller's agent, the listing agent, she ended up throwing in $500 of her commission to make up what the seller should have been doing because she knew they should have replaced a rotten board. I mean, it's not like it's like one little rotten board somewhere in a corner. It was a log home and one of the logs had rot in it. And that's like the wall. I mean, it's like if it rotted, you're like looking out, you know, there's like a hole there out to the outside. And they were refusing to replace that. And it was going to cost like $475 to replace it, which was not all that much considering what it was. They were refusing. They were being jerks. And so the agent kicked in $500 of her commission. And that's really kind of what caused the deal not to fall through. They were jerks up to through the whole thing. But every now and then that happens. You have people on the other side that are just jerks. All right, what are some issues? Seller's issues. That the buyer has secured financing, okay? And then verifying accounting accuracy on the settlement statement. And this is what is important here. You as the broker, you're held responsible by the commission for the accuracy and delivery of the settlement statement at closing or within 3 days after closing, okay? Now, that's the rule, okay? So you don't have to know every single number on that closing statement, but you have to know the numbers that you're responsible for, like the price, the due diligence fee, the earnest money deposit. You know, you go over it with your client to make sure that it's correct. Okay? And they may, and if they're sellers, they may sign early. Okay? And so they might not even see it until then. Hopefully you'll get it ahead of time. But things are weird with sellers now. Things are weird with sellers now. But you are responsible for the accuracy and delivery of the statement, either at closing or within 3 days after closing. So just know that, because that's the rule. That's what's on the test. Now, the very first closing that I had, we got the copy of the seller's closing disclosure, and we got it early. And I looked at it and found an $83,000 mistake before it went to my client. Thank goodness. Okay. And so that was very good. I was able to catch the mistake. We were able to get it corrected before I sent it to my client. And that saved her from having a stroke, right? Because she was going to have $83,000 less than what she thought. Of course, it was a mistake. We would have gotten it all corrected. But if I hadn't corrected that and I just sent it on, would I have looked like a very good agent, a good fiduciary? No, I would not have. So that's why understanding this math is important. It makes you look good. And let's see. We do sellers remotely or via mail. Okay, so Leslie's saying, yeah, lots of times now sellers are doing things remotely, or they come in early. And you just don't, rarely do you see buyers and sellers get together at the closing table anymore, at the settlement meeting. They're not there together at the same time. Yeah, they may be doing it by mail, overnighting things back and forth depending upon where they live, or they may come in early. I will say that in my last class, I had a student who was getting ready to close, and she was the seller. And she said, she came to class one day and she said, I don't have to go, do I? They're telling me I have to go. Why do I have to be there? I don't want to see the buyers. I just want to sign my stuff. And I said, no, you can sign early. In fact, you don't want to be there and see their, confidential loan stuff. That's why they kind of changed this whole process. And so she actually called the attorney and she said, my real estate instructor said, and they ended up going and signing early. So that was kind of a really, really funny story. But yeah, typically now the sellers are doing everything ahead of time, a day or two ahead of time. Right. Okay, what are all of the documents that have to be prepared, right, depending upon what's going on? Of course, the deed. Okay. If there's any type of lien, a mechanic's lien affidavit. A bill of sale for personal property. Now, the bill of sale for personal property is very common. So what typically that relates to is if you're selling the house furnished or partially furnished, that's not a part of what the bank wants to look at, because the bank doesn't want to be financing that, right? This is not one of the loans that includes all of that. This is a loan that is just for the house. So typically what you do is you have everything else come in with the bill of sale. And so the bill of sale usually says all of the items specifically that are going to be included. Okay, they talk about all those items that are going to be included. And then they say that they're going to convey it for $0 and everybody signs it. Okay, so that's kind of what happens to the with the bill of sale. With leases and related documents, if the person is buying a house that is currently leased, or if it is a second home and it's a vacation rental, then they would have to get copies of all of the leases, because they have to honor those for 180 days after the sale. Okay. So we'll have to have that. The seller's lender's payoff statement, okay, the attorney has to have that, because they will actually, what will happen is you'll have to give the attorney, the closing attorney, they'll have to get, or it could be, if there are two, back up one. Sometimes the buyer and the seller use the same attorney. Sometimes they each have their own attorneys, okay? So the seller's lender's payoff statement goes to the seller's attorney. Maybe the same as the buyer's attorney, or they may have their own attorney. They have their own attorney, it goes to them, and then the two attorneys work it out between them. Okay, I've had that happen with some closings before. My seller wanted their attorney. So they're like, I don't trust those other people. I don't know those other people. I want my attorney to do my stuff. So her attorney prepared the deed for her. Her attorney took care of all of the payoffs and all of that and communicated that with the other attorney. And then she paid her attorney for the services that her attorney was rendering to her. Okay, so it doesn't always have to be the same attorney. It can be two different attorneys. But they have to know that because they have to pay that loan off. Now, what's that clause called that makes them have to pay it off? Why do they have to pay off the loan? What clause is it that goes in that says you have to pay it off when you sell? It's got two different terms for it.
Accelerated.
It does start with an A, but acceleration is they call it due because you default. It's the other A word. Yes. Alienation. Alienation. Also known as due on sale clause. Okay. The alienation clause. When you are alienating from your property, you must pay off your loan. You must pay off your loan. So remember, and acceleration and alienation both start with A's and they both deal with the loans. All right. So acceleration, you default, they're going to accelerate your payments and make it all due now. Alienation, when you are alienating from your property, you must pay off the loan that goes with it. Okay. Other documents. So with the other documents, you have the proof of repairs or services. So if you've negotiated things, if you negotiated repairs, then you're going to want to have proof that those repairs have been completed. And typically that's done by the contractor who does it. Okay, you don't want Joe's handyman service out there doing it. You want it to be a contractor, or you want something so that you've got proof that it's actually happened. The financing documents will be prepared. We know we've got our promissory note, we've got our deed of trust. Those are the things that are going to be prepared. The loan estimate will come before that. And then of course the closing disclosure is a part of really a financing document. Your title insurance policy, the lender's going to require that to safeguard them against anything that might happen with the title. And I highly recommend that you always recommend to your clients that they get the homeowner's title insurance policy so that helps to protect them. Hazard insurance, got to get your HO3 policy, right, to make sure that all those things are covered. We'll talk about insurance in chapter 13. That's a short chapter. It's a good chapter. Potentially that could be flood insurance as well, depending upon if they're in a floodplain. Your pest inspection, you're incomplete. So you'll have that documentation of that, what they say about it. And if you have a survey done, you'll have the survey. So lots of different documents may be prepared. Okay, so sometimes it's required. Remember that survey, sometimes it's required by the lender, sometimes it's not. Sometimes it's required by title insurance, sometimes it's not. Okay. Any questions about those documents that have to be prepared? And of course, the most important one is the actual settlement statement. Actual settlement statement. Now, speaking of the settlement statement, and I'm sure we'll mention this in a little bit, but in the settlement statement, there is one settlement statement now for the seller, closing disclosure for the seller. There is a separate closing disclosure for the buyer, and that's when there's a loan involved. That's when there's a loan involved. What they used to use, and when everybody had to be there together at the same time, was called the HUD-1. Okay, it was called the HUD-1. And everybody had to sign the HUD. That's why they all had to be there together. And so when they got rid of the HUD for loans, they went with these different closing disclosures. The seller's closing disclosures, the buyer's closing disclosure. But what do they do if it's a cash sale? It's a cash sale, you don't have all these loans involved. So what do you think they do? Any guesses? Are we still here? Anybody have an idea? If it's a cash sale, what do? They have to document it somehow. Very good. Thank you, Aaron. You're exactly right. They have to document it. They write a bill. Good guesses. Okay, now we're starting to think. Maybe there's some type of an attorney drawn up, bill of sale or something like that. And then Leslie, of course, she should know this one. If it's a cash sale, they still use the HUD. They still use the HUD. So if it's a cash sale, and I've had a cash sale, and the seller showed up, the seller was there, seller's agent was there, buyer was there, I was there, we were all there around the table together with the attorney, and we had to pass that HUD around so that everybody signed, right? So all the sellers signed, all the buyers signed, the attorney signed, and so when it's a cash sale and it's a HUD, you all still do get together around the table and sign those documents, okay? So you may still have that. Now, the sellers could probably come in and sign them early if the attorney allowed them to, but there is an instance where the HUD is still used and you still might all get together. That's not the norm because most sales involve loans, they're not cash, but it could still be done.
Jane, quick question is not
Yeah.
about the lawyers. This is going back a little bit, but typically, if you have one lawyer, is it typically the seller's lawyer?
No, if there's just one, it's the buyer's.
Okay.
Buyer gets to choose their attorney, and then the seller may use that attorney or they may use their own.
Great.
Other questions?
If you use like you said buyer's attorney, would there be some kind of common interest or conflict of interest?
No, there would not be any type of conflict of interest. See, really the only thing that the attorney is doing for the seller is preparing the deed and getting their loan paid off. And those are both, and they have no reason to disclose any information that's not common knowledge to either side. So you don't have to worry about conflict of interest there. Now, I will tell you that the reason my client decided to use her own attorney instead of the buyer's attorney was because it appeared that the buyer's attorney was trying to scam her. And it was really weird because she got an email saying that, see, this closing is coming up and for X amount of dollars, we're going to charge you X amount of dollars to file the loan satisfaction documents at the courthouse to say that your deed of trust has been satisfied. And I thought it was a scam. I mean, I really did. And I showed my broker in charge and he thought it was a scam. And then another broker walked through and said, no, actually they do that now. And I'm like, why do they do that? Because the bank does that. That's the bank's job. That's part of what they're supposed to do. Why in the world? And it's just another way attorneys were making money. So that made my client feel extremely uncomfortable using that attorney, the buyer's attorney. She felt like she couldn't trust them because she felt like they were trying to take money from them that from her that she didn't need to be paying, which was true. She did not need to be paying that money. It was done by the bank. And one of the loans that they wanted to file the satisfaction for, it had already been filed and I found it. And I'm not the attorney going to look for it. I found it. And they said they couldn't find it. And that's why the $83,000 mistake occurred. And so, so she did not use them because she just had a really bad feeling and a bad experience right up front. But typically, many times they will use the same one. It's totally fine.
Awesome. Thank you.
Mm-hmm. Other questions? Okay, so let's talk about the pest inspection. Pest inspection. The buyer is responsible for paying and obtaining the pest inspection and report, except in new construction and with a VA loan where the seller is responsible. Okay, so this is a problem topic. So most of the time, okay, a buyer is going to be responsible for paying for the pest inspection. The time when they're not is when it's a VA loan or if it's new construction, and then the seller is going to pay for that. Okay. Now, sometimes what you can do, if there's a termite bond on the house, right? So the seller has a regular service coming out to make sure there are no termites and that kind of thing. Then sometimes they'll provide a report that the bank will accept, and it may be free. If I'm the seller, I'm going to try to get that report for free. You know, is a nice thing to kind of help the buyer feel good about maybe negotiations for repairs or things like that. But another thing that can happen with that is that if there is a termite bond, then the buyer can assume it, right? They can just take over that protection package and pay for it, and to kind of not have any like break in service. That's the word I was looking for, break in service. But they don't have to. They don't have to. Okay, title procedures. What does the attorney do with the title procedures? So what the attorney is going to do is the attorney is going to do a preliminary title search. They're going to go and look for everything, see if there are any clouds on the title, any challenges to the title, any outstanding loans, anything that is weird, anything that is not expected. They're looking for unusual things, or just to make sure everything's good. So it's a title search and an opinion. Based on that title search and opinion, then the title insurance company is going to issue a title commitment. Okay? Issue a title commitment. So they're going to commit to providing title insurance for that property. So then what happens is after the closing, the attorney, or after, let's use the right terms here. After the settlement meeting, where everybody signed everything, the attorney then goes to the courthouse to file the deed and everything. They do another title search right then to make sure nothing has changed and everything is good. And if nothing's changed and everything's good, then they file everything. And that's what's known as closing. And then at that point is when the affidavit of lien waiver is done. The seller, the seller may be required to file or to sign an affidavit of lien waiver. Okay, they may be required to do that. And it's a sworn statement where the seller assures the title insurance company and the buyer that there have been no judgments, bankruptcies, or divorces involving the seller since the date of the title examination. It promises that no unrecorded deeds or contracts were made, no repairs or improvements were made, and the seller knows of no defects in the title. The seller's the builder. The affidavit should address the payment of any subcontractors and affirm that they are in possession of the premises. Now, this is normally required before the title insurance will issue the owner's policy. And it gives that title insurance company the right to sue the seller if they lie. Okay? So that's going to occur. That signature may be required, and that might occur as a part of the settlement meeting, that affidavit of lien waiver. Right? So preliminary title search, opinion from the attorney, title commitment from the insurance company. After the settlement meeting, the attorney will go check everything again, give his final opinion, record everything, title insurance is issued. Okay, that's kind of the way that process works. As a piece of that, an affidavit of lien waiver may be required, and that would be issued and signed at the settlement meeting. And that's normally just when there is an assumption of the existing mortgage. So that doesn't happen all the time. That's kind of why it's the last bullet, because it's not 100% of the time. The rest of it is 100% of the time. All right, let's take a break there. And when we come back, we will look at conducting the closing. Yahoo! So let's do 15 minutes. We will come back at 10:05. And let's go here. And I'll show you how to pull one. So if I wanted to pull a septic permit, I'm going to go to the, so you would be going to your Association of Realtors. They probably have these links for you. Type that in right. And, oh, and by the way, I'm typing it in because it's blocked. It will not, even though my password is saved, it requires me to type it in. So I'm not just like weird about that. I wish I didn't have to, but I do. In the Triad one, I don't, but in this one I do. So if I come down here, there's a hyperlink that goes to search septic permits. And it's taking me to Department of Public Health online management system. So I can search by the permit number, or I can search by a street address, a PIN, a city, a subdivision, a block, a lot, an owner name. And so I'm just going to search for Mountain. Let's see if I can find this. So after I do this, I click search. And then it's going to pull up if there are any. Okay, so I don't have, okay, here we go. Did it pull up one? Here's one. 170 Mountain Ivy. Okay. So if that was the one I was looking for, all right, then I would be able to actually go and view that. And I could view the septic permit once it opens up here. And so here it is. Maybe it's waiting. So it's taking its time to pull it up. And then I would have the septic permit. And if you're doing the MLS, you're going to want to attach the septic permit to your MLS listing. And here it is. So here's the permit. You can see what they're doing, how they're doing it. 2 bedrooms right here. So you notice it says 2 bedroom. And cabin with the metal roof. So I know exactly which one this is. And you can just see all the different information about it. So there's your septic permit.
Okay, so if we were this person, we were listing this house,
Mm-hmm.
and they had an extra room, and they were saying that was 3 bedrooms. Where we could get in trouble is if we did not pull the septic permit to see that it was only legal for 2 bedrooms. Is that correct? I'm
Yes.
understanding that? Okay,
Yes, that is correct. Mm-hmm.
thank you.
Now that what you just showed us where it said 2 bedrooms, but then under it, it said 4 bedrooms. So can you clarify?
Yes. So with this particular situation, and I just happen to know this because this is where I live. This is not my house, but this is in my neighborhood. So the way that it works, and let's see, where did you see the 4? Is this up here?
Yes, where the writing was, it said 2 bedrooms.
That's
But
right.
then under it, it says structure, number of bedrooms 4, number of people 8.
Yes, that's correct. So what happens here is, and let's go down to the picture and I can show you exactly the way that it works. All right, so if we look right here, here's like the septic, okay, and this is the cabin, 170, okay, and it's 2 bedrooms. Notice there's 165, and there's something going here. Okay. So it is a 4-bedroom septic, but it's shared between 2 cabins.
Oh.
Oh, okay.
Okay. So that's exactly what happened with that.
Is that typical though? Does every home have its own septic, or can some homes share it with the neighbors?
They can share it with the neighbors like this is, depending upon what's going on. Like there can be shared wells, there can be shared septic. It kind of depends upon the size of the lot. Now see, these lots are small. These are 1/3 of an acre lots. And so that's kind of how everything is connected here, the way it was done. But there are other places, if you've got an acre lot or something like that, or 20 acres or whatever, then you're going to have your own septic.
Okay.
This is only an issue where there's not city water and sewer. Because if there's sewer, you can have how many bedrooms you want. It doesn't matter because it's going in the sewer. This is only an issue when it's septic.
Oh, I see. Okay, thank you.
Mm-hmm. Yep. So not every place has septic.
Is Jane, the septic tank, is that something that they have to disclose on the disclosure form, the seller?
Yes. Yes, they do. They have to disclose if it's city water, sewer, if it's septic or whatever. And you should, as a broker, be reasonably aware of what it is that they have. Okay. Because there have been times where sellers think they have one thing and they have something else. Okay. So, I mean, you're pretty safe if you're in downtown Greensboro that they've got sewer, right? But if you're out in the country, then you might want to double check and make sure that it actually is sewer and not septic, even if they think that they're on it.
And if the buyer, I mean, obviously, if it's a below ground septic system, you may not see it, but if, so say it is below ground, the seller doesn't disclose it, or, you know, they choose not to disclose or whatever. So if we can't see it, it's below ground, and they don't disclose it, do we still have a problem?
Yeah, you are liable. You should reasonably be able to figure that out. You should
Okay.
be able to figure that out. So that would be negligent misrepresentation or negligent omission if you were not able to figure that out. And most people, I mean, you're going to know. I mean, you can actually look and see, you know, where does your water come from? Where does your, you know, sewer, septic come from? You know, do you have septic? Do you have sewer? You know, and you can reasonably check that out. And if not, you can always call the health department. Well, yeah, EPA, the health department, for your particular county, and your BIC will know how to get in touch with them. You know, your firm will, and you can confirm what it is, what they have. If you have,
And then I guess if you're selling in that area, you have a pretty good feel for whether they've got.
Yeah, you do. You get the feel for what to look for, and yeah, and it's a thing. So this one actually had a brand new septic tank put in, which I need to find out how much that costs, because I'm probably going to have that done at my house at some point. Not because there's anything wrong with it, but because it's under the screened-in porch, and that's not a nice place for it to be, which is kind of weird that they put it there. But actually, they got a variance. Remember we talked about variances when they built the porch? They got a variance, so they were able to put the screen porch on top of the septic. Weird. You can still dig it out, but the guy that pumped it last time, just as a regular thing, he said, I don't ever want to do that again. Because he said it was a pain in the butt. So, all righty. So the brass tacks, here we go. Conducting the closing. So in conducting the closing, sorry, I had to make sure I was recording, so I had to go back to my page here. Settlement meeting. We have a settlement meeting. It is face-to-face. Ours is typically face-to-face. Now, everybody may be together, like we saw if it's a HUD, or they may not be, you know, meeting at the same time. But we do have the settlement meeting. And so what you're going to have attending would be like the buyer, the buyer's agent, the attorney, right? But you could also have the seller and the seller's agent, okay? The seller's attorney if they were different. So you could end up with like, you know, 6 people there. And if they're married, you can have, you know, the spouses attend and all that. And Rarely do you ever have somebody from the financial institution, the lending institution, or the title insurance company. Rarely do they ever attend closing. It's possible. Okay, so typically the people who attend the closing are the buyer, the buyer's agent, the attorney. You could also have the seller's agent, and if they have a separate attorney, maybe their attorney or maybe not. Okay, so that's typically who is going to attend. Now, we also have the settlement agent in North Carolina is typically the buyer's attorney. So that's the kind of thing that we have. We have a settlement meeting that's face-to-face. The settlement agent is the buyer's attorney. There could be an escrow type settlement, okay? And that can happen if the parties cannot attend the settlement meeting. They agree in advance who will act as the escrow or the settlement agent, and all funds and paperwork are delivered into escrow. Then the escrow agent is an impartial third party who conducts the settlement. When the deed's been prepared, it's considered to have been legally delivered to the buyer under what's called the relation back doctrine. Okay? Now, this is not typically used in North Carolina. So all you need to know about escrow type closing, two things: handled by a third party, not typically used in North Carolina. Okay? Those are two things you need to know about escrow type closing. It's more important to know about ours. We have a face-to-face settlement meeting, okay, conducted by the settlement agent, who is the buyer's attorney. Now, after everybody's signed everything, okay, then we have finalizing the closing. And that's when, okay, the attorney goes back to the courthouse, does one more title search, records everything, the mortgage, the deed of trust, the deed, all those things that have to be recorded. Now remember, we're going to be recording a deed of trust. Other states may be recording a mortgage, but we record a deed of trust and the actual deed. Then after that happens, okay, funds can be dispersed. That's when you get your money. That's when the seller gets their check. Everything has to wait till after those things have been recorded. And then you get the disbursement of the funds. And that's called the North Carolina Good Funds Settlement Act. That's what dictates that. So the attorney can't even give you the check. If you're the seller, they can't give you the check at closing and say, wait until I call you to deposit this. That could get them in major trouble, okay? Because who's to say you're actually going to wait? And then what if something happened? So they're going to make you come back after they have done the recordation, okay? And they will let you pick up your check then. Now, when you are at the closing or at some point, you're probably going to have to have a 1099-S, and I just kind of think about that as being a 1099 settlement, okay, or a 1099 sale. And so that's so that you've got the sales price, the amount of property tax reimbursement, and the seller's, of course, social security number, because they have to notify the IRS about this sale. And that's how they can figure out if you have to pay capital gains, you know, and what they're going to be. And we talked about that. No capital gains on the sale of your primary residence, single 250, married 500. Okay, but it still has to be reported to the IRS. Now, the lender, of course, is important to the closing when you're getting a loan. And so typically the lender is going to require, unless you're escrowing it and they're paying for it, proof that you have insurance. They're going to require that. And but if you're escrowing, then they're in charge. You know, they know about the insurance. You've had to give them the information. They're escrowing it, and they're going to keep paying it going forward. Same thing with the taxes, right? If you're escrowing, then they're holding that money, and they'll be paying it going forward. All right, and so that's really just about the lender's, you know, interest in closing. And rarely do they have their own people show up, but they could. They could. Questions about the closing?
Yeah, can you clarify a little bit when you say they're going to require your insurance? I guess I keep getting thrown with the mortgage insurance is already automatically there. And then in addition, there's a title insurance, and then there's a flood insurance. I guess I keep getting confused with insurances.
No, there are all kinds of insurance. So insurance that they're going to be requiring is that you've got to have hazard insurance, your homeowner's insurance. So all the different insurance that we're going to have, title insurance, that is ensuring that the title is good. The bank needs that, right, to make sure that they're making a loan on something that you actually own. You should have it as well to protect you against claims against third parties. So we've got title insurance. If your loan is an FHA loan that requires a mortgage insurance payment, you've got that, your MIP. If it's a conventional loan, then you have, if it's 80%, right, you've borrowed more than 80%, then you're going to have PMI. Okay, and that's your mortgage insurance. So you've got that. That's insuring the lender in case you default. Then you have to have homeowner's insurance, also known as hazard insurance, on the house, so that if it catches fire, you can rebuild. And they're going to require you to have that. And the reason they're going to require you to have it is because if it burns down, you know, they've got nothing, right? Because that house was your collateral. So if it burns down, they've got nothing, you've got nothing. So they're going to require that you have hazard insurance. And then if you are in a floodplain, your lender is also going to require that you have flood insurance. For the same reason, if it floods out, they've got nothing. Now, if you don't have a loan, you can, you know, roll the dice on your flood insurance. You shouldn't. You should have flood insurance because your homeowner's policy doesn't cover it. It's a separate thing. And but you don't have to if you don't have a loan, but the lender's going to require it if you're in a floodplain or flood zone. Okay, so those are all the different types of insurance that's involved, you know, with a house. Title insurance, mortgage insurance if required, your homeowner's insurance, and potentially flood insurance. So they're all there and they're all required.
So say just if I did not borrow 80% and I had a conventional loan, I would not have to get the PMI. I could just do homeowner's insurance.
Right. So if you only borrowed 70% on your loan, then the lender would not be charging you PMI. Okay. That's going to automatically be a part of your payment. So you don't have to worry about going out and getting it. They're just going to include it for you.
Gotcha. Okay. Thank you.
Uh-huh. Alrighty. So this is what we were just saying here a minute ago, because this is super important. Okay. And this might be something they would try to get you on. Okay. When is the closing? The closing is when the attorney records the deed in the deed of trust. Settlement meeting is when everybody signs everything, right? But the closing is not finalized until things have been recorded. And then they can disperse the money as mandated by the Good Funds Settlement Act. So that's how that works. All right, back to our good friend Dodd-Frank. Remember we talked about them in financing. We're going to visit them again. Before October 2015, duplicate forms were required by Truth in Lending and RESPA, and Dodd-Frank consolidated the forms. Okay, it consolidated the forms. So now we don't have duplicate content anymore because it seemed like things were super duper duper confusing. And so they tried to simplify things and make them not as confusing anymore. So here's what we had. There used to be what's called a good faith estimate. Okay, a GFE, a good faith estimate. And you had to get that within 3 days of your application. Then you had the early version of the truth in lending statement. Okay, so you had truth in lending and good faith. Now, what you have is one document that covers both of those things called the loan estimate. And you must receive that from your lender within 3 days, okay, of applying for your loan. Okay, and this little diagram is on page 528. If you want to look at that, in your book, you don't have it up in front of you with your notes, but you can look at it there in the book, and there's some explanation for it again. Kind of the same thing we're going over, but you can just follow that little picture in the book if you would like. All right, so the good faith estimate and the early truth in lending are now one document, the loan estimate. Then, at the closing end of things, we have the HUD-1, the final truth in lending, and they have been combined, and now we get the closing disclosure. So they really simplified things. Instead of you having 4 documents, now you get 2. Questions about that?
So these are given to you from your bank when filing for a loan, or at least the loan estimate?
Yes, the loan estimate is going to come from your lender within 3 days after you apply for the loan.
Right, and then the closing disclosure comes from
The bank as well.
bank. Okay.
You'll
All right.
get the closing disclosure, you'll review that, it'll go to you, it'll go to the attorney. But yes, you get that, and you have to get it 3 days. So you have to get the loan estimate 3 days after you apply for the loan or sooner, and the closing disclosure 3 days before the closing or longer. It can be 4 days before closing, but it can't be 2. It must be 3. And you have 3 days to review it before you close. And they do not budge on that. If they do, they could get in major trouble.
So then that's like for the bank itself.
Right. Yes.
Awesome. Thank you.
Mhm. Yeah.
These are 3 business days.
Three. Let me count these days just to make sure, because I just had one. So, gosh, mine was. I think mine was 3 calendar days.
Oh, okay.
Let me think. Well, Saturday's a business day, so
Oh, yeah, okay.
I got it on Thursday, Friday, Saturday, Monday. I think I got it, or did I get it on Friday, Saturday, Sunday, Monday? I have to remember exactly when mine is. It's Saturdays count for sure. Holidays do not count. And so let me just think about that to make sure we're adding Sunday. We're supposed to add that. Just have to think about that.
Yeah. Ooh, Daddy smells his breath. He gonna have to brush his teeth. All right, that's your mama breath from in the living room.
Okay, guys, just remember to mute when you're not talking. So otherwise, we're going to hear other stuff. So yeah, so just let's see. 3 business days. 3 business days, not calendar days. 3 business days. I'm thinking that's exactly the way it is. But holidays don't count in that. Holidays don't count, and Sundays don't count.
But
I
Saturday.
believe that's correct.
Thank you.
Mm-hmm. They're not gonna say, you're just gonna need to know. They're not gonna ask you too specifically about. Well, you do have to know the days. You got to know 3, okay? But they try not to in the past get you too confused with business days and banking days and all those different kinds of days, because there are business days include Saturdays. Banking days do not include Saturdays. Calendar days include Sundays. Holidays don't count. There's all that kind of stuff. So I'll give you a little like definition of what all the days are to help you kind of remember that, because that's kind of a crazy thing.
Thank you.
RESPA. So RESPA, this is the Real Estate Settlement Procedures Act, Regulation X. We've already talked about Regulation Z. So now we've got Regulation X. We talked a little bit about that in financing, right? It's to protect consumers against abusive lending practices. It applies to, and this is key here, all first lien federally related residential loans, okay? It requires accurate accounting of funds, eliminates kickbacks and unearned fees to agents, limits escrow reserves, and it's enforced by the Consumer Financial Protection Bureau. Okay? So if you remember, we had our little acronym for RESPA. And so if we look at our little acronym for RESPA here, let's see. See who remembers our acronym for RESPA. What are all the things RESPA required us to do? Who remembers? What's the R stand for? Dum, 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 dum.
Real Estate Settlement Procedure or Procedure Act.
That's what RESPA stands for. What's the R?
Responsibility?
No. Required.
Oh,
Our acronym, required disclosures. This is our acronym we looked at last weekend to how to remember all the things RESPA requires. So the R is required disclosures. And this is our loan estimate and our closing disclosure. Okay. Now, anybody remember now what the E stands for? The E is escrow limits. Escrow limits. They can't go escrowing a ton of money from you. It has to be a reasonable amount. Reasonable amount. Okay.
Servicing requirement.
Okay, so with escrow limits, let me tell you what the escrow limits are. And so one of the things that you need to know about escrow limits, and we'll talk about them in a little bit more detail later, but one of the things that you need to know about the escrow limits is that they can only collect 1 month at a time in your monthly payment. So they can get some money up front, right? But they can only do 1 month at a time in your monthly payment. So when you've got that PITI, you know, the I part of that and the T part of that, the taxes and insurance. From the PITI, okay, it's always going to be 1/12. It's always going to be 1/12. So when we're having to calculate and they give us the annual amount and you've got to figure out the monthly amount, you're always dividing it by 12 because they can only collect 1 month at a time in your monthly payment. Okay. Even if you're like, so if you end up with too little in your escrow, then they adjust it for the next year, right? But it's not a random number. It's always got to be like a consistent number. Or if it's too much, sometimes your thing will go down a little bit.
So Jane, they can never take out your full year's taxes in one payment?
Correct. Not when they're escrowing. Not when they're escrowing. Yeah. So up front, when you close, they get a little bit more. Like many times they will say is, what they'll say they'll say, and when we're doing our problems, they'll say, and 2 months of taxes, or 3 months of insurance. But they can't go say 12 months of taxes and 12 months of insurance up front, okay? And we'll see in our problems. Sometimes they'll say 2 months or 3 months, you know, but just remember that it can't be like an entire year at one time. Okay? And then people are now starting to get this servicing requirement is the next one. So they have to tell you who is servicing your loan. And I just got one of those today. And I was going to read it to everybody. Let me read it to you because I got one of these today. And this came from Fannie Mae. And it says, notice of assignment, sale, or transfer of your mortgage loan. And it says the ownership of your first lien mortgage has been transferred by Wells Fargo Bank to Fannie Mae. Fannie Mae is a government-sponsored enterprise chartered by Congress. We do not make mortgage loans, but instead provide funds to lenders by purchasing the mortgage loans they make. The assignment, sale, or transfer of the mortgage note does not affect any term or condition of the mortgage deed of trust or note. Transfer of your mortgage loan to Fannie Mae has not been publicly recorded. Fannie Mae does not service your loan. It is important that your monthly payments be sent directly to your servicer and not to Fannie Mae. All correspondence and inquiries should be addressed to your servicer. The servicer has authority to act on our behalf with regard to the administration of your mortgage loan and respond to any questions about your mortgage loan. The servicer of your mortgage loan is Wells Fargo Bank. You may contact them by mail at so-and-so address or by calling this. They may also have a website. In the unlikely event you need to contact Fannie Mae, you can write us at whatever their address is or telephone us at 1-800-2-FANNY. I think that's hilarious. And then partial payments. If you make a payment that's less than the full amount of your regularly scheduled monthly payment, your servicer may accept a partial payment, and hold it in a separate account, or may not accept a partial payment. If your loan is sold, your new lender may have a different policy. Please do not send your mortgage payments to Fannie Mae. Payments sent to Fannie Mae will be returned to you, and this could result in late charges or your account being past due. Fannie Mae is not responsible for late charges or other consequences of misdirected payments. So that's Fannie Mae's actual statement. So now that we've talked about Fannie Mae and we've talked about servicing requirements, we were just able to put the two together with a real life experience.
If so, they can transfer like they did with that, or they can sell your loan to another mortgage lender. Is that right?
Well, they sold the loan to Fannie. Wells
Okay.
Fargo sold the, so Allen Tate sold it to Wells Fargo. Wells Fargo sold it to Fannie.
Okay.
Okay.
Say
So Allen Tate, when Allen Tate sold it, see, if Allen Tate hadn't sold it in time for my first payment, I would have made my first payment to Allen Tate because they're both in the primary market. Fannie Mae's in the secondary market. So Wells Fargo sold it to Fannie so that they could make somebody else a loan, so they could make more loans, but they continue to service it.
Okay. When they sell a loan, like say when Allen Tate sold it to Wells Fargo, could that change your monthly payment?
No,
Okay.
no, it cannot.
Is Allen Tate a mortgage?
Banker.
They're a broker or
They're a banker.
They're a banker. Okay.
Yep. I thought they were a broker, actually, because they kind of act like a broker. But when Jennifer talked to us last weekend, she said they are a mortgage banker. I kind of still put them in the category of banker/broker because they're not going to keep any of their own loans, and they're gonna sell them all. But they are. But she said they were bankers. All right, the P is prohibits kickbacks. Okay, so that's the other part of RESPA. So it prohibits kickbacks. And with regard to kickbacks, that means like anything, even things that you can maybe get if you're a property manager, you cannot get, okay, with regard to a RESPA loan. So prohibiting kickbacks is a major thing with regard to that. All right, so they will probably ask you about that. And it's just, it eliminates kickbacks and other referral fees that tend to inflate the cost of settlements unnecessarily. And they also prohibit lenders from requiring excessive escrow account deposits. So they don't give you like the specific number, but just they can't do excessive escrow limits. So we'll see in our problems, like I said, 2 months, 3 months, that kind of thing. And then the last one is associated businesses. So if you have different, like some of your big, like Allen Tate has its own mortgage company, they have its own insurance company, and you have to disclose that you have those things. So it's really cool for a consumer sometime to do one-stop shopping and have just one place that they go for everything, but they're not required to use that one place. Okay, so that's our major provisions of RESPA and how we kind of remember it using the RESPA acronym to help us get going with it. So questions about RESPA? About that particular part of it? And this is the main thing you have to know. We go into this in more detail in post, but we will review and revisit this acronym. Okay, so what I wanted to do next is to actually show you, because we're talking about it, not a septic permit. We've seen that already. I have to get out of the septic system so that I can get to, oh, that's not what I want. I want this. Make sure I get to the right document here. So we're not going to look at that one. I'm going to go down to here. So here's an example of the loan estimate. So remember we were saying that within 3 days of applying for the loan, you have to get the loan estimate. So I wanted us to all take a look at the loan estimate. So this is in your book on page 535, if you want to follow along there, okay? And just, again, this is not on the, they're not going to have to go, oh, this is on the loan estimate, but I want you to see one and be familiar with it. So you see the loan amount, the interest rate, the monthly principal and interest, your PI, okay? Can this amount increase after closing? No, 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 no. Prepayment penalty. Does it have a prepayment penalty? As high as $3,240 if you pay off during the first 2 years. Okay. A balloon payment? No. Okay. Payment calculations. So look right here. This is showing our mortgage insurance. So here's your PI. Here's your mortgage insurance. Here's your escrow. Okay. Now notice after you get below your 80%, this goes away. So your payment changes. Okay. Do you have escrow? Yes. Okay. 206 property taxes, homeowners insurance, and there could be other in there. What are your closing costs? What is your cash to close? Okay. And then they come down here and they kind of show you all these different things. Here's your loan origination fee, your application fee, your underwriting fee. And these are estimates. Recording fees, transfer fees, your homeowner's insurance 6 months, mortgage insurance premium, prepaid interest, property taxes, and then your initial escrow, 2 months and 2 months. Owner's title insurance policy. Over here, appraisal, credit report, flood determination, flood monitoring, tax service. These are things you cannot shop for. These are things that your lender is automatically doing. Services you can shop for. Okay, and they're just estimating how much they think they're going to cost. Pest inspection survey, title insurance, lender's title policy, settlement agent fee, the title search, these types of things, okay? So depending upon what your attorney charges you impacts this. And then they tell you your total closing costs, which is adding up all of these various numbers. Your down payment, less your deposit. Okay, that would be like your earnest money deposit or whatever. And your estimated cash to close. All right, then they have to show you the total amount of you will have paid in principal, interest, mortgage, insurance, and other loan costs, and the amount of principal you would have paid off, just because they want you to feel nauseous. Your APR. This is your cost over the loan term expressed as a rate, not your interest rate. And the total amount of interest that you will pay over the loan term as a percentage of your loan amount. Right? And so then other things will not allow assumption of this loan. See right there, so no assumption. We intend to transfer servicing of your loan. Okay, so they do this, and then you have to say that you have received it. So that's what your loan estimate is going to look like, something like that. Okay. Now, if we scroll on down here, let's see if here's a closing disclosure. Closing disclosure looks very similar to the loan estimate at the beginning. What's the loan amount? What's the interest rate? What's your principal and interest? Okay, and then it's showing this stuff here. All right. Closing cost, cash to close. Notice how these things change because these are like the real values. And now you see the real stuff. And this, you actually have to do some of these on your post-licensing test to be able to get credit for that. Okay. And when we look at this, okay, you can see exactly what happened here with this. So we have origination fee, 25% of the loan, points, application fee, underwriting fee. So the underwriting fee is when the banks, they get all of your information together, you know, your credit report and what you owe on this and what you owe on that and what you have in your investments and in your bank accounts and what the appraisal says, and they send it to underwriters. And underwriters are people that really give an opinion of is this a good loan or not? Is this a good loan? So they send it to the underwriters. It comes back from underwriting, and either they're going to say, yes, we're going to make the loan, no, we're not going to make the loan, or we need more information. So for example, in mine, everything was good to go, went to the underwriters, we thought everything was great, and then the underwriter noticed in the appraiser's report that he wrote that the GIS photos appeared to be off, because if they were accurate, then half of somebody else's house was on my land. The underwriters kicked that back and said, we don't feel comfortable making this loan until you get a survey to prove that the house is not in on your land, because that would be an encroachment. So got the survey, everything went through, but that's what the underwriters do. So that's what they do. Then we have our appraisal fee, who they paid it to, credit report fee, flood determination fee, flood monitoring fee, tax monitoring fee, tax research fee. You see all of these different fees in here. Were they paid at closing or were they paid before closing? So you can see that. Okay. Apparently there was no money paid to John Smith appraisers. Oh, there it is. Ah, paid by others. So that's actually over here. So the buyer didn't have to pay that. Pest inspection, survey, title insurance, lender's title insurance, the settlement agent fee, and the title search. Okay. Total loan costs, recording fees, the deed and the mortgage to record them. Okay. Transfer tax, also known as excise tax. Your homeowner's insurance premium, you have to pay that up front regardless, okay? And then prepaid interest, property taxes, That's how it's prorated. Here's your escrows. And then HOA stuff is coming down into here. And then here's our commissions. That's what we're interested in. Home warranty fees, things that maybe that the seller paid for the buyer. And then we get all of this calculated cash to close. And then the front of this kind of adds it all up. And then that's how you figure out how much you've got to bring and how much they're going to get. Okay. So question, how can you afford the closing fee? I don't understand. I guess you have to have that amount of money before they'll give you the loan. Okay. So I did just want to bring that up. Just let us take a look at it. Now we'll look at it again in detail. And it's not something that you're heavily tested on here. You're tested on it in post. Tested on it in post. But here we have to just be familiar with it. All righty. So disclosure requirements for lenders, what we were just talking about, that loan estimate. They have to give you a booklet called Shopping for Your Home Loan so that you understand the process. That's kind of their equivalent of our Working with Real Estate Agents brochure. You know, that's what they have to do, Shopping for Your Home Loan booklet. And then they have to get the loan estimate given 3 days of loan application. Cost control by the lender may not increase. They can't say they're going to charge you one thing and then charge you another. Questions?
I have a question. Maybe that person about the how do you afford closing costs? Well, this is my question in regards to that. Could you take that out of the loan somehow or no? That has to be directly out of your bank upfront money you already have.
It depends. It depends. Sometimes they will allow you to finance closing costs in, sometimes they will not. And that's a discussion to have with your lender.
Okay.
Okay. And I just confirmed that I was correct. It is business days, 3 business days. For all these days are business days. So business days are Monday through Saturday, do not include Sundays or holidays. I thought that was right, but you know how sometimes you'll get ready to dial a phone number you've dialed 1,000 times, and all of a sudden in your brain you kind of go, wait a minute, is that the right number? I was saying that out, and all of a sudden I was like, wait a minute, is that the right thing? But yes, that is correct. So I was correct on that. It is business days. So again, loan estimate within 3 business days of loan application. Cost control by the lender may not increase. Disclosure requirements. Okay, lender requirements affect buyers. So you have to have your closing disclosure delivered to you within 3 business days prior to settlement, excluding Sundays and national holidays. Okay. Delivery must be confirmed. You have to confirm that you have received it. And if they send it by snail mail, you got to get it 6 days before. All right. Must allow 6 business days. So rarely does anything happen by snail mail now. Usually things happen by email. All right, this is important here. Changes that require a new 3-day waiting period or a 3-day review period before you can close. Number 1, an increase in the APR by more than 1/8% on fixed rate or 1/4% on variables. All of a sudden thrown in a prepayment penalty, or changing the loan product. It was conventional, now it's FHA. It was FHA, now it's VA. Okay. It was fixed, now it's adjustable. So changing those basic loan products can require that new 3-day waiting period, that 3-day review period. So no, it's APR, an increase in the APR, prepayment penalty is added, or a change in the basic loan product. Those are the 3 things that can cause that settlement waiting period to start over again. What do you have to do? You are held responsible for the accuracy of information you should reasonably know. Okay, on the HUD, if it's a cash sale, and on the closing disclosure document, if it's a loan. Not reporting a mistake could constitute willful misrepresentation. Like, for example, if they're giving you $10,000 more for your commission than what you're supposed to get, you should report that. I know you really want the money, and you're like, well, hey, they figured it out. I guess they know what they're doing. No, you're responsible. You're responsible. So you need to make sure that you look at that and you report any mistakes. And it doesn't mean necessarily that you've got to go, oh, this should have been 0.275 or whatever. You just have to question it. Is this correct? Is this correct? I want to make sure that I've got these numbers right. All you have to do is just ask, and they'll go check it out, because they want it to be right too. And they will make mistakes. People can make mistakes. I found mistakes on my last one. And then there was the last one that I did when I bought something. I found a mistake. And they had prorated the HOA fees incorrectly. The HOA fees were $365 per lot last year. It's going up to $500 per lot this year. When they prorated things based on last year's payment. The reason that they did it is because they thought the dues ran on a calendar year, and that the sellers had already paid for it, because it was February, March. It was March when we closed. They thought they'd already paid for it. But this particular year runs June 1 to May 31st. So they had not already paid it. And so it made a difference of like, it was $50 is what I had to pay instead of like $850. So that was a huge thing. And it was not anybody doing anything wrong. It was just a misunderstanding of exactly how it worked. And so we got that corrected. Everything was good. Okay. All right, so I want to take a break here, because we're going to start getting into that closing disclosure settlement, looking at that a little bit more in detail, and talking about credits and debits. And, if you guys drink coffee, now's the time to go get a cup, to make sure your brain is really going to be focused when we come back from break. So we'll come back at 11:15. The recording. Okay, what we're going to start talking about now is how closing works, how the settlement statement works, how that closing statement works. We looked at all those numbers and things, but what does it really mean? Okay, how does all this stuff kind of come together? And so here's kind of the way we're gonna talk about this. And what's important is who pays for what? Who pays for what? Okay, who do you think is going to pay the broker's compensation? The seller. The seller pays the broker's compensation. The seller pays the broker's compensation. Okay. All right. Who's going to pay an attorney fee?
The buyer.
The buyer.
Yes, the buyer. The buyer's typically going to be paying the attorney's fees. Okay. Who's going to pay recording expenses?
Buyer.
The buyer. The buyer, because what's being recorded? The deed they just got and their deed of trust if they have one, right? So they're going to have to pay for those things being recorded. Who pays for excise tax?
The seller.
Seller, exactly right. The seller pays the excise tax. Okay. Who pays the title expenses?
Buyer.
Buyer, buyer, buyer. Very good. Who's paying the loan fees?
Buyer.
Buyer. Who's paying tax and insurance reserves?
Buyer.
Buyer. Appraisal?
Buyer.
Buyer.
Survey.
Buyer.
Due diligence fee.
Buyer.
What are we getting a trend here? Buyer, 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 right? So the buyer pays almost everything. Almost everything, okay? There are only certain things that the seller is going to have to pay, okay? So the seller always pays the broker's compensation. So I'm gonna put an S right here. Oh, I do not want that to be yellow. Let's try this in some other color that's maybe better to see. Let's try red. Let's erase this. Oh, good. Eraser. Okay. Now let's go back to the pen. This is pretty cool. All right, so seller pays compensation. Okay. Broker's compensation. Seller pays excise tax. The buyer's paying everything else. Okay, the buyer's paying everything else. The only other thing that the seller ends up paying, okay, is going to be prorated expenses. And we'll talk about how those things are prorated here in just a minute. Okay, so you always look for those to be the things that the seller is paying and know that the buyer pays everything else. Okay. Now, things are always negotiable. Things are always negotiable, but this is as a general rule of thumb. This is as a general rule of thumb. Okay. All right, so kind of keep that in mind.
I thought there were certain instances where the seller does not pay the broker's compensation.
Well, I think I just said that this is the general rule of thumb. There are always ways that it could be done differently. Always ways that it can be done differently. One of the ways, the broker may not be owed compensation, right? Because the seller sold the house themselves and it was exclusive agency. It may be a for sale by owner and the buyer's having to pay their buyer's agent's compensation. But these are the general rules of thumb, okay? Last closing that I had, I paid it all. I paid the excise tax. I paid everything that was prorated. It was a way because, okay, when you're negotiating, they wanted a higher price. I didn't want the higher price because I didn't think that it would appraise for that price. So we negotiated the price down by those amounts. They got the same amount of money. I got things to appraise properly, which helped me with my loan. And so there's always exceptions. In fact, every single thing that we've ever said could be, it depends. But these are the standards, and this is the way it'll be on the test. So these are the standards, the way it'll be on the test. All righty. Now, what we need to know is debits and credits. Debits and credits. Amount to be paid by the buyer or the seller is a debit. The amount that you're getting is a credit. The amount that you're getting is a credit. And so if we look at the closing disclosure, okay, you can kind of see who is going to have to pay for what. All right. So let's pull up a closing disclosure and take a look at who pays for what. And to do that, I have to go here. And let's go to, so is that the loan estimate? Yeah, this is a closing disclosure. All righty, so when we look at this, okay, you are seeing seller paid and buyer paid. This is what we brought up before, but now we're just going to kind of annotate it just a little bit, all right? So notice this is borrower paid, all right? And every one of these can be a little bit different, but this is the norm. This is the norm. And so Again, we're looking at all of our loan costs here. Appraisal, credit report, flood, all of these kinds of things. Okay. Notice as we're scrolling down through this, all right, what do we see for the seller's side? We see this right here, transfer tax, also known as excise tax. So you may see the word excise on the test, or you may see the word transfer tax. Okay, excise tax, transfer tax. So we see them paying that. All right, so that's one thing that they pay. Notice what else they pay when we come down to here. Okay, they paid a home warranty. Okay, that was negotiated, that they included a home warranty. So that may or may not be happening. In this particular one, they paid the home inspection fee. Normally the buyer would pay that. Okay, but they might tell you the seller pays the home inspection fee. If they don't tell you that, then you assume that it's by who normally pays it, which would be the buyer. Okay. But what they do pay, notice right here, is the commission. Okay, alpha and omega, 50-50. So if we notice what they're paying here, they are paying commission, excise tax, and there's one other thing that they normally pay that I do not see right in front of me on this form. And that is that the other thing that they always pay is deed prep. Okay, and so think about that. They are the ones who are giving the deed to the buyer, so they must have it prepared. So they prepare it, and then the recording of it is the buyer's responsibility. All right, so deed prep. All right, so let's kind of take a look at these things again. So they're always going to pay the transfer tax. Also known as the excise tax. They're always going to pay the commission. Okay. And they're always going to pay deed prep. So those are the three things they always pay. Standard. All right. It's not to say they couldn't be negotiated out differently, but these are normally the three things that they pay. And then other things may or may not be negotiated to be done differently. So just remember those three things: commission, transfer tax, also known as excise tax, and deed prep. Looks like deep prep because my D kind of, deed prep. Questions about that? Okay. So general, yes, go ahead.
Jane, I'm sorry.
No, go ahead.
So those three things, the transfer tax, the commission, and the deed prep, did you say those could possibly be negotiable, or those are absolutely not negotiable?
Everything is always negotiable.
Okay.
Everything is always negotiable.
Okay, thank you.
Mm-hmm. But those are the most commonly things. If somebody just said, what's a normal way is it going to be? That's normal. That's normal. It's normal that the seller pays the transfer tax. It's normal that they pay the deed prep. It's normal that they pay the commission. Can all that be negotiated? Yes. But is that what normal? Yes. Are they going to give you something weird and abnormal on the test? No. No, they're not going to give you weird and abnormal on the test. It's hard enough for people to get the normal stuff right on the test. They're not going to give you weird and abnormal on the test. Okay.
Jane, I wanted to just ask you quickly, this is kind of an aside, but I've noticed we were taking a test the other day, and I can't remember which one it was on read, or what is it, test?
Learn to
Yes. But anyway, they have, in a lot of cases, you have different names for the same thing, like transfer tax, excise tax. But in a number of situations, there might be 3 or 4 different names for the same thing. And, you know, the question is do we have to know all those names, or because I got one wrong just because I had never seen what I thought was, and never, you know, I've never seen that description, and then I find out back, you know, embedded in the text somewhere, there was another name.
Right. Yeah. So on the test, you're going to see the most common names. But so let's say excise tax and transfer tax are the common names now. All right. Back in the day, and Leslie just put this up, I was just getting ready to say, if you look at old ones, they were called deed stamps. So you may still hear them called deed stamps. All right. For our test purposes, the best I can remember, it's either transfer tax or excise tax.
Okay.
Okay. But deed stamps is also a term. I'm trying to think of some other things. Oh, so now what's called a soil suitability test used to be called a PERC test for septic. So you may see PERC, you may see soil suitability. They are the same thing. You may see Kleenex, you may see tissue. It's kind of like that, but they don't go too crazy with it. But one thing that you will see is that our term provisional broker is sometimes called salesperson. Okay. And salespeople have to report to brokers, just like provisional brokers have to report to brokers. So that's only on the national part, that on occasion you see salesperson, but just think of that as being a provisional broker, somebody who has to report to a broker. And they're not asking you really specific questions. They'll just use the term, you know, and then it just means somebody that's a real estate agent. If you see salesperson, they mean somebody that's a real estate agent. And then again, that's just because different places have different terms for different things, but they don't go too crazy with it. All righty. With regard to prorations, 2 things to remember. Seller owns the day of closing for all proration calculations. Seller owns the day of closing for all proration calculations. And we use a 360-day year, 30-day month for our math questions on the test. Okay, 360-day year, 30-day month. So remember, seller owns the day of closing, 360-day year, 30-day month. That's key to remember. All righty. When we talk about proration, you need to know things that were already paid or not yet paid. So you'll hear that called prepaids. What were the prepaids? Already paid. Or what are accrued items? Things that are accruing because they are yet unpaid. They are yet unpaid. So many times we see prepaid, we say unpaid. But you may see the word accrued, and just know that means unpaid. That means unpaid. Accrued means unpaid. All right, so seller owns the day of closing, 360-day year, 30-day month, prepaid, and unpaid or accrued. All righty, so I want to show you how you figure prorations for, we'll just do property taxes. So we're hitting into math now, right? And we're not going to do a whole mini closing thing yet. We're going to wait on that just a few minutes, but I am going to show you exactly how to do these prorations. So I need to stop share here and share from here. All right, so this is the way to make sure you always get your prorations correct, okay? I do this every single time, and people tell me it's super duper helpful when they do it. All right, so we have to have our scenario. Let's say that property taxes are, I don't know what they are. They're $3,400 for the year, okay? Our closing is March 15th, okay? Now, have the taxes been paid yet?
No,
No, why not?
because of the tax year.
Right, when do the bills go out?
July, I believe.
That's when they,
September.
that's right.
September.
They determine the rate in July. They determine the ad valorem tax rate in July, and the bills go out in September. So if we have a closing date of March 15th, then we know the taxes have not yet been paid. Okay, unless they tell us in the problem, and the taxes have already been paid. So, but if they don't tell you in the problem, you have to know that tax year. Okay, and that just makes sense. You know, the tax rate's determined in July. The bills go out in September. They're late if you don't pay it by January the 5th of the next year. Okay, so here's what we do. This is how I do every one of them. I write January and I write December. Okay, and then I put my closing date in here. And you kind of guesstimate it, so I'm going to go March 15th. Okay. Who lives in the house before closing?
Seller.
Seller.
Seller. Okay. Who lives in the house after closing?
Buyer.
The buyer. Okay. So if the taxes have not been paid yet, who's going to have to pay them?
The seller.
No.
Buyer.
When do the bills come out? The bills don't come out until down here. Remember, the bill comes out in September?
Oh,
So who's going to be paying that bill?
the buyer.
That's right. The buyer's going to have to pay the bill. Okay. So if the buyer's going to have to pay the bill when it comes out in September, this means that the seller's going to have to give the buyer their share of the taxes at closing so the buyer can pay them when the bills come out. Everybody with me?
Yes. So the tax is never being paid in advance.
No, then you wouldn't know what to pay. Okay, so you assume that they're paid at the appropriate time unless the problem tells you they've already been paid. And it would tell you they've already been paid.
Mhm.
Okay, so otherwise we know that they're not going to be paid because we don't know what to pay till we get the bill because the rate could change.
Okay.
So like if this was happening like real time, so this would be like they would be paying the 2020 taxes or the 2019 taxes?
2020.
That's what, okay.
2020, because this is 2020. Okay. So the bills for 2020 comes out in September. The bills for 19 had to already been paid, or else there'd be a lien on the property because they were due by January the 5th of 2020. And on January the 6th, if you haven't paid them, then they actually filed the lien on your property. Okay.
Okay, this may be, I'm sorry if I'm asking stupid questions, but
No, you're not asking stupid questions. You're asking.
so would the seller actually only have to pay January to the buyer?
Yeah. So the way that this is, they pay for the taxes while they lived in the house.
All right, so that's all they're not paying the whole thing. They're just paying March and then the buyer will pick up March on.
Yep. So here we go. All right. So now, we've gotten this far. We know that the seller's going to give the buyer the amount of money that they owe the buyer for the time that they lived in the house so that the buyer can pay the taxes later. Okay. Now, if you know this thing right here, sometimes you don't even have to do math because they give you multiple choice. So do you think the seller's going to give the buyer a little bit of money or a lot of money?
A little bit.
A little bit, a little bit. And the way that multiple choice questions come up is, well, let's just go ahead and do the math. So we know that $3,400, we have to get this to a daily rate. So we divide by 360 because that's what we use for our math. So 3,400 divided by 360 is what? Hopefully people are getting, did y'all get 9.44?
Yes.
Okay. All right. So we know that that's our daily amount. It's actually 9.444. So I usually carry it out 3 decimal places. So 9.444. All righty. So my seller lived here January, which is 30 days, February, which is 30 days, and 15 days in March because the seller owns the day of closing. So they have to pay for March 15th as well. All right. With me so far? Does that make sense? So that's 75 days. So 75 times 9.444 is what?
708.33.
Yep, 708.33. Okay, so we are going to debit the seller and credit the buyer 708.33. So that's how prorations work. Okay. And this is the format that you do to figure out all of them. Right? You've got to figure out the daily rate. You've got to know who's going to have to pay it. And so then you have to figure out who's going to be debited, who's going to be credited, right? So the way that the arrow goes up here, the arrow goes from debit to credit. Debit to credit. Okay. All right, questions. Ask me your questions about this, and then we'll try another one.
I missed it. Where did 75 come from? Does that represent?
75 is the number of days that the seller lived in the house. The number of days they have to pay taxes for. They lived in it 30 days in January, 30 days in February, and 15 days in March. Because we're doing a 360-day year and a 30-day month.
Got it. Thank you.
Mm-hmm. All right, should we try another one? Let's try another one. So in this one, let's say that the taxes are $5,000. Okay, and closing is June 10th. Okay. So for this one, and we got to remember 360-day year, 30-day month. So just always remember that. So I do the same thing. January, December. Closing is June 10th. Seller lives in it here. Buyer lives in it there. Taxes have not yet been paid. So the seller is going to be giving the buyer money, right? This means I'm going to debit the seller and credit the buyer. So let's figure out the rate. 5,000 divided by 360. I'm gonna have to get out my calculator. 13,888. 13,888. It's actually 8889, so I better say 13.889. Okay, there we go. So that's my daily rate. So I got that number. Then I've got to go over here and I've got to do, how long did they live there? January, February, March, April, May, 10 days in June. Okay, so I'm going to add all that up. 3, 6, 9, 12, 1, 2, 3, 4, 5. January, February, March, April, May. 1, 2, 3, 4, 5. It's 100, it should be 160 days. Is that right? January, February, March, April, May, and 10. 160. Okay. So then I take 160, multiply by 13.889, and I get some number. What do we get?
$2,083.20.
$2,082.20. Okay. So I'm
83.
going, and what? Is that right?
83.
Oh, $2,083. Okay. So this is going to be debit the seller, credit the buyer, $2,083.20. Question.
You got different numbers.
Well, I'll just have to do the math myself.
You got the 24, 2222.24.
Yeah,
13.
that's what I got. Right.
Okay, I'm having y'all tell me the numbers. I have not done the math. So I'll have to get out my calculator and do the math.
$2,222.24.
Okay. Okay. Yep, that's right. It's 2222.24. Yep. All right. So see, this is why. I mean, but I don't like getting out my calculator because it takes too much time. 2222.24. Is that what y'all said?
Yes.
Okay. Yep. Okay. So I'm just going to grab my calculator because every time I do it with my phone, I have to unlock my phone and it takes too long. So let me get a calculator. All right. I'm only as good as my mathematicians, right? All righty. So questions about this?
Jane, I think we can do the math for you. I hate to make you have to do
That's
it.
all right. That's right. I got my calculator out now. I just was having to unlock my phone. It would go to sleep every time before I'd have to type it in again and have to start all the numbers all over again. It was just kind of a pain, but we're good. We're good now. I got my calculator out and I can, and it can see, it can work. All right, here we go. All right, so let's do another one. Let's say the taxes are $2,034. Okay, for the year. And our closing is October the 15th. Okay. So there we go. So let's try this one. Do the same thing. January, December. Okay. October 15th is going to be somewhere along right here. October 15th. Okay. So, who's lived in the house up until October 15th?
The seller.
The seller. And who's getting to live there in the fall? In the winter?
Buyer.
The buyer. Okay. Have the taxes already been paid?
Yes.
I'm going to tell you yes. Okay. At this time, it may be yes or no, but typically they will tell you in all the problems, they'll tell you taxes have already been paid. Okay. Or yeah, so we're going to say yes, taxes have already been paid. So if the taxes have already been paid, the buyer's got to give the seller some money this time. So we know we're going to debit the buyer and credit the seller. Now we got to figure out how much. So 2,034 divided by 360. What did y'all get? $5.65. That's what I got. $5.65. Okay. Now, The next part of this, the easy way to do this is to always go with the smaller numbers, right? And so I would say 15 days in October, 30 days in November, 30 days in December. Okay, and so I would add those up and I would get 75 days. And I'm going to say 75 times 5, 65. And if you do that, you should get 423.75. Okay. And so that's going to be debit, buyer, credit, seller. Debit, buyer, credit, seller. Okay. 423.75.
Yes, Jane, I'm confused. We don't have to calculate for, I mean, I know it's each day that the seller's going to be in the household, but you don't calculate the 10 months, just.
Yeah. So let's look at it this way, because here's another way to do it. And I figured this was gonna catch you guys a little bit. So let's go ahead and do this 423.75. Okay. And let me erase some stuff here. All right, so we know we've got 565. So the other way to do this is, how long did the seller live there? January, February, March, April, May, June, July, August, September, and October. All right, so that's 285 days. 285 days. All right. So if I take 285 times 5.65, I'm going to get, I bet you, 1610.25. Okay. So the sellers had to pay 1610.25. Okay. But now, here's the next part that's important, is have the taxes been paid or not? If the answer is yes, then the buyer has to give the seller money because the seller's already paid them. If the answer to this question had been no, okay, then it would have gone the other way. It would have gone the other way. If it had been no, then the seller would have to give the buyer $16.10 and $16.10.25 so they could pay the taxes off.
Oh, okay. I follow now.
So it all depends upon, have the taxes been paid yet or not. So if they've already paid them, the seller's already paid the whole $2,034 if the answer is yes. And they've just got to get back the part for where the buyer lived there. And if the answer is no, then the seller's got to pay the buyer for the whole time they live there, and then the buyer takes care of the rest. Okay, so this is why, to me, drawing this chart right here makes all the difference, because you get set out your whole year, you put in your closing date, and then based on if this is yes or no, you draw your arrow, you know, seller to buyer or buyer to seller, so that you're going to know which way the things are going to go. Now, on the test, here's what you're going to get. You're going to get an A, B, C, D, right? And one's going to say, debit, buyer, credit, seller, the 423.75. The other one's going to say credit, buyer, debit, seller, 423.75. Then you're going to have one that says, I guess you can figure this out by now, debit, buyer, credit, seller, 1610.25. And then you're going to have debit, seller, credit buyer, some way, shape, or form, 16, 10, 25. So they're going to give you the 4 scenarios, the 4 ways this could be done. Okay. And so what you've got to do is you've got to figure out the answer. So let's play around with this just a little bit. Okay. If the taxes had been paid, what would your answer be? If the taxes had already been paid, what would your answer be? Yeah, so the answer is going to be A. Okay, if the taxes have already been paid, because the arrow is going to go this way. Debit buyer, credit seller, the smaller amount of money because the buyer's living there the shorter period of time. And if the answer to this question had been no, the taxes have not been paid, then we know our arrow goes the other way, right? And so the answer then becomes D. It then becomes D. Now, let's play a little game with this just for a second here. What if you got this problem and this and so you said okay, and let's say that they said the answer to this was yes. Okay, taxes have already been paid. Could you answer this question without doing any math?
Yes.
Yes.
Yes, you could. Yes, you absolutely could, right? Because we know if the taxes have already been paid, the buyer's got to give the seller money. And is it going to be a little amount or a big amount? A little amount, because the buyer's living there a shorter period of time. That's why we draw this out. So if they give you this multiple choice and you can draw out this graph here, sometimes you don't have to do the math. You just have to think about it logically. Okay. So that's why I think drawing this out really helps. Does everybody kind of see how you didn't even have to do math for that? Do I need to explain that in a little bit more detail, or are we good?
So when we calculate the days for the years, it's like we end at January 30.
Yeah, so for pre-licensing, they consider every month to be 30 days long. And so 30 times 12 is 360. So it's a 30-day month and a 360-day year. That's the way they do it in pre-licensing.
Mm-hmm. So it ends in January 30th.
Yep, January has 30, February has 30, March has 30, April has 30, May has 30, June, they all have 30, regardless of how many they really have. For the purpose of our calculations, every month has 30 days.
But if you do the step right, but if you're missing the days, like if you get the wrong number of the days, it's considered wrong too, even if you do the step.
That's right, that's right. But if they give you one like this, there's no way you should miss this.
Mm-hmm.
There's no way you should miss this, because you know out of this particular problem that the buyer lived there the shorter period of time, October to December. And so you know that they're going to have to give the smaller amount of money. You didn't even have to do math.
Yeah.
Yeah. So use that logic to help you double check what you're doing. Okay. Now, if they are typically just testing you on proration, not on credit debit, if they're testing you on proration, they get real picky. They get real picky, and we're going to see one of those here in just a minute. Okay, we're going to see one of those here in just a minute. So, in fact, we'll do, Yeah, let's do one of those. So the other thing that we prorate is interim interest. Interim interest. Now, what in the world is interim interest? Does anybody remember? Interim interest. Anybody remember what that is? Who pays it?
It's the interest paid on the loan for the first month.
The buyer.
Yes, yes, exactly. So the buyer pays it. So the buyer pays it. Okay, from
The first day of the month.
closing to the end of the month. Okay, because let's think about it. Let's say we close on April 17th. Okay, we close on April the 17th. When is my first mortgage payment going to be due?
June.
Yes.
June 1st.
My first mortgage payment is going to be due June 1st. Okay, that's going to include my principal plus my interest, but the interest, the principal is for June, and interest is always in arrears, so it's the interest for May. Okay, so what I have to pay at closing is the interest that takes me from the day of closing until the end of the month. Okay, so from April 17th to April 30th. Okay, so is the bank going to make me pay on the 17th, or are they going to give me a break and let me start paying on the 18th?
No.
Oh, yeah, exactly. The bank is never going to give you a break. They're going to make you pay every single day. All right? The bank never gives you a break. So here's where you have to count on your fingers. All right? Here's where you have to count on your fingers. So this is the way I'm going to count this. You can't subtract. You'll get the wrong number. And this is where they get like really precise with you. So I have to pay interest on April 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. I have to pay 14 days of interest. 14 days of interest. Okay, because the bank will never give me a break. They're making me pay on the 17th as well. So I pay 14 days of interest. Right? So how in the world do I know how much that is? So let's say that I have a $150,000 loan at 4%. Okay, it's at 4%. So I figure out that amount of interest.
$14,458.
I'll get $6,000 for that.
Mm-hmm.
Divided by 360. $16.667. That's my daily rate again, times 14 days. $233.33. All right, so that's how you do interim interest.
Jane,
Yes,
I thought the seller owned the day of closing.
the seller does on the day of closing, but is this the seller's loan?
No.
This is the buyer's loan, right? So the seller owns the day of closing for everything that can be prorated. This is not prorated. This is solely from the buyer. This is the buyer's loan. Okay, so
Okay.
one way to think of it is seller owns the day of closing for everything but interim interest. You can just, if that helps you remember it that way. The other way to think about it is seller owns the day of closing for everything that's prorated. Okay, The buyer's interim interest is not prorated between the buyer and the seller because the seller has nothing to do with the buyer's loan. This is all between the buyer and the bank. So the way I remember this is, okay, this is the buyer's loan. That's got nothing to do with the seller. Starts on the 17th. Okay, that's the day of closing. I know the seller usually owns the day of closing, but wait a minute, the bank never is going to give me a break. So I got to pay interest on that day too. Okay, now on the test, they will give you 233.33 and they will give you 216.67. They will make sure that you know that the buyer has to pay interim interest on the day of closing because it's their loan and therefore the seller does not pay the day of closing for that. Okay, so they will test you on that for sure and make sure you know the buyer pays interim interest on the day of closing because has nothing to do with the seller. It's the buyer's loan. Everything else has to do with the buyer and the seller. You know, we're prorating taxes. We're prorating HOA fees. You know, we're prorating things. But, okay, things that only have to do with the buyer, the seller's not involved with. Make sense? Does that make sense?
Yes, thank you.
Additional questions on this?
So interim interest always going to be debit to the buyer, credit to the seller?
No. You were half right. It's always going to be debit to the buyer. But who's getting the money? Seller's not getting the money. Who's getting the money for that interim interest?
Bank.
The bank. The bank. Okay? So this is one of those things that is the buyer side only. Like, remember we said the seller pays the excise tax. That's not prorated. The seller pays the commission, right? The buyer pays the attorney's fee. The buyer pays the interim interest. The buyer pays the excise escrow amounts. Okay, so this has nothing. The buyer's loan has nothing to do with the seller. And now, if you just think about this, that makes sense. Okay, so you got to kind of think about the logical process as well as just the math. Because if you get hung up on the math and you're thinking prorate, I got who owns this, who owns that, whatever. But then you think about, oh, this is the buyer's loan. Of course, seller's not going to pay anything to that. And the seller's not going to get any money for it because it's the buyer's loan. Who's going to get the money? The bank.
Okay.
Okay. All right. So we're going to take a little break right now. And then when we come back, we're going to do a mini closing problem. Okay. We're going to do a mini settlement problem, which will take us right up until lunch. Okay, this is going to put together all of the math, well, almost all the math except for length times width that we've learned to this point, we use in the mini closing problem. Okay, so let's take our break now and we'll come back and we'll do one of those. Big problem. All right, so we're going to do on page 567, we're going to do an easy one to start out with. You're going to go, what? We're going to do number 26. We're going to do number 26. And so when we do these kinds of problems, and you will have one of these on the test, okay? And it'll either be how much is the seller going to get at closing, or how much does the buyer have to bring to closing? Okay, that's the way your problem is going to be set up. Okay, you're going to ask you one of those two things. And here's how we're on page 567, number 26. Number 26 is the one that we're going to look at. So we're going to walk through this one step by step. So this one is asking me, because again, I'm following my little criteria for how to answer questions. So I'm reading the question first. What is the amount the seller will receive at closing? Okay, so this is all about the seller. So here's what I'm going to do. I'm going to write the word seller up here. Okay. And then I'm going to put debit. Let me see. I always debate on how I draw out my little chart here. I'm gonna draw it out like
Okay, and what's the number of the question?
26. Page 567, number 26. Okay. So let's do it like this. These are going to be debits. And this side's going to be credits. Okay. And then I'm gonna write them all down, and I'm gonna add them all up and subtract. So I'm gonna do it one step at a time. So the first thing it says is they're gonna close on June 15th. Okay, so I'm probably gonna need to know that. So I'm gonna write June 15 up here. So I just remember that. Okay. Then I'm gonna go.
You said page 527, number 20.
567, 567. 567, like 567, 8, 9, 10. 567, number 26. Okay, let me put that in the thing. 567, number 26. So 567, number 26. That should be the end of unit 21. Okay. Did everybody find it? Let's make sure everybody found it. Good to go. Okay, cool. All right, we're going to assume that that means everybody's good. All right, so the first, let's go step by step. The contract price is $445,000. Is that a credit to the seller or a debit? And it's okay. When you guys answer, that is so cool. Even if you get the wrong thing, answer, because it means you're thinking, and that's going to really help you on the test. Even if you say the wrong thing, you're thinking about it, and you'll remember that you said it wrong, and you got corrected. So you got your misconception corrected. Okay, so don't be afraid of that. So yeah, it's a credit. So I'm gonna put 445 right here because that's a credit. He has $24,310 in closing cost. What do we think that is? Credit or debit? That's a debit. 24,310. 24,310. Including a 5% commission to his brokerage firm. Now, that's a little bit of an odd way for them to write that particular thing on there. And they will not be that's a little vague, actually. That will not be that vague on the one that you get on the test. They will tell you more specifically. All right, because since this says including, they have included the commission in that 24,310. It doesn't mean that you need to add it again. All right, so that one's just a little vague there. But if it says that's their total closing cost, including a 5% commission, then that means you don't go figure out the commission again. All right. Real property taxes are estimated to be $4,800 yearly and must be prorated. So let's go ahead and do that. 4,800, okay, yearly, must be prorated. So we know we divide by 360, correct? And
13.3.
$13.33, is that what everybody's getting? 13.33?
Yes.
Perfect. Okay, cool. So we're going to write down our 13.333, okay? And now I'm going to draw my little thing. I'm going to draw January through December, okay? And then I'm going to put June 15th. So that's pretty close to the middle here. So I've got 6/15, all right? And so it says that real property taxes are estimated to be $4,800 yearly and must be prorated. So they have not yet been paid, is what that tells me. They're estimated to be $4,800 yearly, right? Because the rate comes out on July 1, okay? So they have not yet been paid. So I know the seller and the buyer, and the seller's going to have to give money to the buyer so he can pay him later. And he's going to give him January, February, March, April, May, and 15 days in June. So he's going to give him, what is that? 1, 2, 3, 4, 5, 165? 165 days worth. Okay, so 165 times 13.333 is some number.
219.94.
Yep, 219.94 or 220. If you left it in your calculator without rounding up, I think it comes out to be exactly 220. So again, this is rounded to the nearest dollar, so we're close enough with the 220. And is that going to be a credit or a debit? Debit, yes.
Debit.
It's a debit because the taxes have not yet been paid. So we know the seller's got to pay the buyer. That's why we got a little arrow going this way. So we're going to put 220 over here. Okay. Then it goes on to say his first mortgage payoff is $249. So that's a debit, right? Because he's got to pay off his mortgage. Okay. And then it says excise.
Why do we
Question.
have
It's 2,200 and
Yeah.
Huh?
It's 2,000. It would be 2,200 rounded up.
yeah,
Not
Oh,
220.
2,200? Okay.
yeah,
Okay. Missing a zero.
yeah.
There we go. Okay. 165. Yeah, that's right. Yeah. Missing a zero. Okay. So then his mortgage is 249,000. Okay. And excise tax are charged to the seller as well. Ooh, how do we figure excise tax?
Divided by 500.
What divided by 500?
The sale price.
That's right. 445 divided by 500. And then we've got to round it up. Calculators here in the dark. Let's see.
890.
890, and that's a debit as well. Okay. And then it says, what is the amount the seller will receive at closing, rounded to the nearest dollar? So then I like to go back and double check. 445, yep. Closing cost, 24,310, yep. Property taxes, 2,200, and he should have to pay about half of it. Yep, that makes sense. First mortgage, yep. Excise tax, yep. So then I'm going to add these together. And what do we get? $276,400. Good. So we're all agreeing on that. Okay. And then we're going to subtract 445 minus 276,400 equals so what did you get? Yeah, so the answer is C, right? 168,600, which I think is C. There we go. So that's your question that puts it all together. It puts it all together. And that's an easy one. We started off with an easy one. The sellers are easier than the buyers. Okay. Where did we get the 890? The 890 is the excise tax, also known as the transfer tax. So we know that the excise tax is always the sales price divided by 500. So the sales price divided by 500 is my excise tax.
How does that, Jane, how does the rounding work on that? Because I think it said something about rounding up to the nearest 500 or something.
No, you round up to the nearest dollar. You round up to the nearest dollar. So the way I do it's rounding up to the nearest dollar. Okay, so if this had come out to be had it come out to be 890.01, the answer would have been 891. Okay. Now I find that to be much easier to do than there is a way that says so that things are always a multiple of 500. That let's say the sales price had been 445,012. Then you could round that up to 445,500 and then divide by 500. Okay, but to me that's an extra step. See, so to me, I just go ahead and divide by 500, and then I just round up. So I think that's easier. That's easier. Okay. And so where does the 500 come from? The state of North Carolina has decided that excise tax is $500. Okay. They're the ones who came up with that particular number. They could have said it was 600. They could have said it was, it's like $1 for every 500 that you have to, that you pay. So for every $500 of the sales price, you have to pay $1 in excise tax, but it's always rounded up. So that's where the 500 comes from. And that was a number that's given by the state. Okay, other people may not have it, or their number may be different. Other states, I don't even really know, but it's determined by the state of North Carolina. Okay.
Hey, Jane, I would like to clarify the closing cost, the 24,310.
Yep.
That included the broker's commission. That would also be the deed prep. Is that what that's referring to?
Yes, it is. So it's referring to anything and everything the seller had to pay.
Okay.
Okay. They just didn't make it too hard for you. They didn't break it all out.
Okay.
Okay.
Mm-hmm.
So are we ready to do a super hard one? Let's do a super hard one. Let's do number 25. And we're going to do number 25 by letting you guys do it on your own first, and then we'll work it together as a class. Okay, because we got to get it out there. And this one's going to be, just so you know, what's the buyer got to bring. So it's going to be more involved. The buyer side's always more involved than the seller side. So let's try that one on your own, and then we'll go through it together as a class. So I'll probably give you like at least 15 minutes to do this, and then we'll go through it together.
Oh, what's the page number?
The page number is 567, and we're doing number 25.
Thank you.
567, number 25. How's the problem coming? We got about maybe 4 more minutes.
It's
Or do we need
hard.
more than that. We good?
Well, there must not be. Okay. Oh my God, I don't know.
So the correct answer is D. Those of you working on it. But let's see how we figured this out. All right, so let's kind of go through this. And so we are saying, what must the buyer bring to closing? So this is all about the buyer. Oh, let me move this over to the side. Buyer. And we can do debits and credits. Okay, so lots of people getting C. So we're off by, what are we off by? $80. Let's see, 560, 480, and we're off by $80. Okay. So something, we're close, but we're off by $80. It looks like we're off by insurance. Okay, so we may have forgotten the insurance. So let's look at it like this. And I'm just going to go right down without working out all the math first. And let's see what we get. So our purchase price is $395,000. So that is definitely a debit. That's definitely a debit. Good with that. And then we've paid $15,000 in earnest money. Is that correct? That's a credit. Okay. And then the amount of our loan is $310,000. So that's a credit. Okay. Then we have an origination fee of 1%, and that's a debit. And that's 1% of my loan, $310,000. And then I'm paying, I guess, 1 point on this, which is also going to be 1% of $310,000. So that's $3,100 again. Okay. And then I'm going to have to, what am I doing? Escrowing my taxes, $600, 2 months of that. 2 months of taxes is going to be 600. And then it wants 2 months of insurance, which is going to be 80. Okay. And then what's the $480? Oh, I have to pay insurance up front for a year. So that's $480. Okay. And then my prorated taxes of $1,000. Okay, which is, and then additional expenses of $1,200. Okay, so does that look like everybody's chart?
I have a question. Do we have to pay the insurance for the whole year or just 2 months?
So depends on what they tell you in the question. So in our question, sorry, I've got my book open to 17 different pages. So let me get back here to the question. I just dropped it. So it says, the lender is requiring the borrower to deposit 2 months of taxes and 2 months of homeowner's insurance premium into an escrow account. The homeowner's insurance premium for the first year is $480 and is to be paid at closing. So they're telling you in there that you have to pay the $480 for the first year of insurance up front, and you've got to start escrowing so that when it comes due next year, there'll be enough money in your account to pay it. Okay, so they actually tell you that in the problem, but that's very typical. You always have to pay your first year's insurance up front. Think about if you have a house, you've always got to pay your insurance payment, up front. Okay, unless they're letting you pay it over time. But when you're escrowing, the bank ain't gonna let you pay it over time. They want it up front, and then they're gonna be collecting for what you got to pay next year, right? They're not gonna let you wait till the last minute because they're helping you budget for it.
Hey Jane, can you tell me where the $1,000 came from again?
Yeah, so I think that this is real property taxes for the year are $3,600 and have already been paid by the seller. So I've got $3,600 divided by 360, and what number is that? That must be like 10, right?
$10.
Right, yeah, $10.
Okay, so that's $10, all righty. And then my closing is September the 20th. So closing is September the 20th. And so the way that I'm going to figure this out is, now I'm going to count it just the way that I would make sure that you don't, mess this up. So September 21st, 2nd, 3rd, 4th, 5th, 6th, 7th, 8th, 9th, 30. So I've got 10 days in September, October, November, December. So that's 100 days. So 100 days times 10 is $1,000. And I've got to pay that to the seller. I've got to pay that to the seller because he's already paid the taxes.
Okay, that makes sense. So what I forgot was that the buyer would have to pay back what they'd already paid.
Correct. Okay. So we've got our $395, then our origination fee. This is our right here. We say the lender's charging the borrower 1% origination fee. So that's 1% of my loan. Now, I know my loan is $310,000. So $310,000 times 1% is $3,100. Then it goes on to tell me 1 discount point. So that's my second $3,100 is the other discount point. Okay.
So what's that 1,200 again? That 1,200, what this came from?
The 1,200, it says additional closing
Oh,
expenses for the buyer total 1,200. So that's my additional expenses, okay? And so they're kind of in the order that they appear in the problem. So how do you know the discount point is 3,100? Because it said it was 1% of, that's 1%. A discount point is always 1%. So if my loan is $310,000, it's 1% of 310. If it had been 2 discount points, it would have been 2% of 310. So 1 point is always 1%. Other questions?
So most of the time we will pay for the whole year for the insurance, plus how many months they will require?
Escrow, yeah. Plus how much they require for escrow. You do. You have to do that. That's so you've got insurance from the very first day you close in case it burns down that night. Okay. So other questions about how we got these numbers? So the key for this is to do each thing in order, one at a time. Okay, so I'm doing 395, I write it down. Then I'm doing 15,000, I write it down. And I write down the closing date because I know I'm going to need that. I've been approved for a loan, I write that down. 1% origination fee, I figure that out. 1 discount point, I figure that out. Okay, 2 months of taxes. Okay, I got to go find the taxes. Well, the taxes are $3,600. I got to divide that by 12 to give me 1 month's worth of taxes. Then I got to deposit 2 months worth of taxes. Okay, so that gives me the $600. Then I got to have 2 months of insurance. All right, let me go find the insurance. Well, that's $480. I got to divide that by 12. Then I got to multiply that times 2, and I get the $80. Then it tells me, okay, insurance for the first year is $480. I got to pay that to closing. All right, let me put the $480 in there. So there we go. Then I get to the real property taxes. And I've got to figure those out. They've already been paid by the seller. So now I got to go back, find my closing date, prorate my taxes, stick that in there. Then they tell me there's $1,200 additional closing cost. I stick that in there. Then I add my math up and I subtract. Then I add all my math up again and I subtract to make sure I didn't have a typo when I was punching it into my calculator. And if I get it, you know, if I could do it twice and everything turns out okay, and it's one of the answers in the choices, then I'm pretty sure I got it right. Okay, and there is one of those on the test that you have to do. Okay, now we do a lot. We'll probably do like one of these a day for the rest of the time, or something like that, or some part of it, because this covers everything. This covers you kind of knowing how to do everything. You got to do discount points. You got to do excise tax. You know, if we do a whole one, you got to do excise tax. If we do the seller side, you got to prorate stuff. You know, you got to really kind of do all the things you got to do in one of these problems. So you'll either get a buyer side or a seller side, and it's random. So I never know what anybody's going to get. But it'll be buyer or seller, and it's random. So other questions? What questions? Now's the time to do questions.
I am thoroughly confused. I actually did this by hand. I didn't use a calculator. I came up with the $79,560, but I don't have the $1,000 anywhere.
Well, you don't have the $1,000 anywhere. Well,
no, I did everything manually, and I probably did it weird, but I added everything up, and I come up with $79,560, but nowhere do I have the tax prorations.
So you must have gotten something else, typed in the wrong number for something else, just by $1,000 off.
We are going to do more of these, right?
We're going to do one every day. So Nicholas, huh?
Just one?
Well, I mean, if this was all we did, we wouldn't finish in the rest of the chapters. So we'll do at least both sides every
Major
day.
math
Hmm?
test. Are there several of these?
One.
I mean, how much of this is the
Have you been in
test?
the book? Are there a bunch to practice in the book?
Yeah.
Yeah, they're a bunch to practice. I can give you a bunch to practice on. But
And
you
how much of this part? And I'm sorry because there's just so much information. How much of this, like these math, is this the main math problems we're going to be doing? Where they lump it all together?
There's one on the test.
Oh, there's only one.
Yep.
Oh, okay.
Yep.
Jane, is there an easy way to determine whether it's a debit or a credit? That's what's confusing me. What goes on one side, what goes on the other?
Yeah. So you think about things that you're getting money for or credits. Things you're having to pay are debits. So you have to pay insurance. That's a debit. You have to pay an origination fee. That's a debit. You have to pay the price of the house. That's a debit. You've already paid your earnest money deposit. That's a credit. You're getting a loan from the bank. That's a credit.
I think that's what threw me off, the earnest money deposit. So we have to think of that like that amount of money is going to be automatically taken off of the loan amount.
Taken off of the purchase price amount.
Oh, the purchase
amount.
That's
Because
right.
that's your deposit. That's like you're down, that's your earnest money deposit. You made that deposit, and so you got to get credited for it, right? Because that money's already gone out of your account. It's sitting there in escrow somewhere, and they've got to take it out of their trust account and give you credit for it on
Right.
purchase. Okay.
Okay, that kind of threw me off for a quick second because I'm like, I'm paying that. But since it's going off of the purchase price, it's considered a credit. Okay.
Yep. Yeah. So it's like you paid it. Now you've got to get credit for it.
Okay, got it.
Okay. Otherwise, you'd be paying it twice. If that wasn't in there, you would be paying it twice, and that would not be good. So a discount point is 1/8% yield to the lender. It charges you 1% of the loan, okay? And it's 1/8% increase in yield to the lender is what the difference is there. So there are two pieces of the discount point. There's what you have to pay, which is 1% for 1 point. And then there's the amount that increases the yield to the lender, which is 1/8%. So two different ends of that. Yay, Leslie, I'm glad you found your math error that you just can't add. That's usually where my errors are too, plugging them into the calculator. All right, so I think everybody's probably ready for a little bit of a lunch break. And when we come back, we're going to talk about property evaluation. Property valuation, how you do CMAs and those kinds of things. So real property valuation is what we will be hitting first thing this afternoon. And I will see you guys then. And we'll do questions, of course, at the beginning. So think of all your questions and we'll do that. And then we'll hit 17. Have updated the schedule, so it's now correct. If you look online, now the dates are right, and you will see that we are looking at Unit 17 this afternoon, 11 and 12 tomorrow, 13 and 16. May 16th will be 18 and 19, and if we need any time to catch up or review, 17th will be all day Appendix A, and getting ready for the practice test on the 23rd. Then we have another review, and then there'll be a brief review on the 24th, and then the final exam. So kind of got everything back on track there. I don't know where my brain went on those dates. Maybe I was finished and I stopped in the middle. I don't know. That was crazy.
Jane, can you talk about the cram that you put on the Facebook page?
Yes, let's see. Oh, the cram. Yes. Cram. So Julie, who's another one of the instructors, will be doing a cram for you guys this Friday from 9 to 1. And so It's a comprehensive review of everything that's on the test. Super helpful. We always have a different instructor do it than the one that teaches the course, just so you get a different perspective. So you have two different perspectives. What I tend to find out is that when people are taking somebody else and they take my cram, they're like, oh my gosh, I wish I'd had you for class. And then when somebody takes my class and they do somebody else's cram, they say to that cram person, oh my gosh, I wish I'd had you for class. So it's just good to hear it from a different person. So I will be giving you guys the link to that.
Do we have to sign up for it or pay for it or anything?
No, it's free. It's free,
Okay.
included, and it is free. And
Will it be recorded?
I don't know. I don't know if she records or not. She may record. I'm going to give you the link right now to it, so everybody will have it. And so you can just copy this link. It's in the chat right now. You can copy it, and then you'll have it ready for you on Friday.
Is that the only one that'll be available for us?
The only cram? Yes. So, and the reason is that PSI is open. The testing centers are open. PSI is open in Greensboro now. Winston opens in June. So you guys will be ready to go right after you finish. So the reason that there was a cram was kind of spread out a little bit before is that they finished on April 15th and they can't take their test until now. So their cram was a little bit later just because it's really supposed to be a cram for the classroom test / final test. So that's what it is. However, I will tell you that on Learn Test Pass, if you scroll down to the 100% exam and additional resources, there is an online recording of a cram that I did before the coronavirus. So you can watch that, and it has similar review. So there's that one.
That'll be about as extensive as the one on Friday. Because I have to work, so I just wanted to see if there
Everything's free. This one on Learn Test Pass is free. The one on Friday is free. So this one right here, Cram Course Online, when you go to this, it's a link to a recorded YouTube video of the cram. It's 2 hours long. There I am. Yeah. So it's the cram. And the reason that it's 2 hours long is that we cut out the test and the review of the test because the particular cram test I gave that day, because it's a different one every single day. I mean, every single time I do it, I kind of mix it up. So that would have been kind of weird to have that on there. So anyway, but these are all the topics that we cover in cram. So there's a 2 hour cram for you there. And that's free for you to watch. And Julie may record hers. I'll ask her. And there is a thing that you need for her cram if you're taking it. It's under problem target, and it's this prohibited acts exercise. Prohibited acts exercise. So you will need that for her class on Friday. And these are like your willful misrepresentation, those kind of things, so that you can kind of test that. Like an agent knows that a house has a leaky roof but fails to disclose such information to a prospective buyer. Is that, willful omission, willful misrepresentation, negligent omission, negligent misrepresentation. So it's one of those. So she has an exercise that you guys do with that. So you will need that. But as long as you're in Learn Test Pass, you'll have it. So you have her Zoom link. I tell you what, I can put this Zoom link in a thing on Learn Test Pass. Let me just do that down here for the cram. I'll put it right here, and it will be it'll have to be text.
Do you also have the link to do the background check?
Yes and no. I can show you how to go to it. But so let me just put it here. So now the link is on Learn Test Pass. So everybody has that. So it's under Cram Zoom link under problem topics. Okay. And just remember that it is 9 to 1. I'll post a reminder on Facebook that it's 9 to 1 on Friday, but that's it. And it can't be on weekend because we have class on the weekend. And so that's kind of how all that stuff works. We try to do it as close to the last weekend as possible. So typically we do it like while you still got one weekend and then the test is the following weekend. So you can kind of see where you're weak, and that gives you, time to review it. But it's free to everybody in the class. Now, with the background check, what you do with the background check is you start out at the Real Estate Commission website. They got all kinds of information on here, but you go apply for a license. And they have like this little video about the licensing requirements. But as you get into this, as you get into the application, you have to create, I don't even know if this is going to work for me because I already have a license, so I have a different one. But as a part of that application process, you apply for the background check. Okay. So I think several people started doing it last weekend or the weekend before because I started getting, I probably had about a half a dozen emails or text messages or Facebook posts, maybe it wasn't Facebook, but something saying, I need the code. And I'm like, that's the secret code that Lane will give you once you pass. And so until then, you can do everything like but that. But I think you go ahead and get your background check done as a part of that.
Okay, thank you.
Mm-hmm. So I'll go to that. Other questions? Okay, so after we cover Unit 17, we will be 75%. We'll be at the 75% point. And so that's the meat of it. All the other stuff is really cool stuff, but the majority of a real estate transaction is in the first 75%. So again, questions about anything from before lunch or earlier, otherwise, anything at all like that? Okay, so let's start figuring out how you know what a house is worth, because that's what property valuation is. It's not evaluation, but it is valuation, determining the value. Get up my questions here. So we're going to calculate different approaches of value. Notice the math is just right up front. We're going to define the various definitions of value. What you do is different from what an appraiser does. Okay, and you have to make sure you understand the difference. That's a test question. Okay. And then we're going to talk about steps in the appraisal process and the approach used by appraisers. And notice that it's valuation approaches used by appraisers. So we are looking for the value, so it's called valuation. All right, an appraisal. It's an estimate or opinion of a property's market value on a specific date. And it's always done by a licensed appraiser, and it's always following specific guidelines. Right? And becoming an appraiser is significantly more difficult than becoming a real estate agent. So when you go through appraisal school, after you complete everything, then you have to apprentice with a licensed appraiser who is willing to take you on for quite a period of time. It's over a year.
Isn't it hard to find somebody to do that?
It is. It's very hard.
Because it's almost like training your competition.
Right. Exactly. Exactly. So, you know, it's a very difficult field to get into. Rigorous curriculum, and then you have to have somebody willing to, you know, help you do that. And same thing with inspections. If you're becoming an inspector, you've got to have somebody that you work with for a while. But appraisals is really, really, really tough. And so, yeah, because you don't want to be training your competition. Now, I guess if you had an appraisal firm, you know, and you were wanting to hire people, but still, you might want to do it then, you know, but so you'd be in control of the people working in your firm. But it's difficult to become an appraiser. Key thing about this, if I had my, you know, I've got a little laser pointer, but if I point to it, you can't see it, right? Because it's a laser pointer. It's not something that's an online laser pointer. Is that it's good for the date that it's submitted, right? So the appraisal is good for 1 day. It's good for 1 day. The next day, values could change. So it's always good for 1 day. So that notice it says on a specific date. And that's kind of something we don't think about. We think an appraisal, I just had an appraisal 3 months ago. Isn't that one still good? No, it's good for 1 day. It's good for 1 day. So that's kind of interesting because the market is always changing. Things are always impacting the market. Now, your analysis that you do is called a comparative market analysis. And it's to find a probable sales price. Probable sales price. And that's called a CMA. So when you're doing it for a client, you're looking for probable sales price, and that's called the CMA. Once you become a full broker, not only can you do a comparative market analysis, which you can also do as a provisional broker, but once you're a full broker, you can give a broker price opinion, which is a comparative market analysis for somebody that's not your client, that's paying you a fee to do it, right? So they're the same thing. They just have different names based on who they're for. So you conduct a comparative market analysis to help your client find a probable sales price of a piece of property they're getting ready to sell or a piece of property they're getting ready to buy to make sure they're not getting ripped off. Once you're a full broker, meaning you're not under supervision of your BIC for everything that you do, then you can do the same thing, has a different name, BPO, and it's for a fee. Now, why in the world would anybody ever be doing that? Well, somebody doing it for sale by owner may not want to list with you, but want to pay you to give them a price opinion. They could do that. A bank who has reacquired a property because of foreclosure and they're getting ready to put it, you know, they want to sell it or they want to see what it's done or they're getting ready to, they could ask you for a broker price opinion. Okay, so those are some instances where you might be doing a broker price opinion instead of a comparative market analysis. They're the same type. You're searching for a probable sales price, but they just happen to have two different names. Okay, two different names. So, one of the things that happened with, this is why we have to call this a CMA and we have to call it a BPO, is because it's different from what an appraiser does. They're actually determining value. Okay, and so what happened is back in 2007 when we had the crash, okay, real estate brokers were like given a lot of BPOs for entities that had no potential of becoming clients. And so that became like a major deal, became a major deal because it was like competing with appraisers. And so now we're just very you know, we are very specific about saying this is not an appraisal, but it is an estimate of probable selling price or probable leasing price, not a value, not a worth. Okay, it has to be done by an appraisal to be, and an appraiser to actually be the real value or the real worth. Alrighty, so when we're looking for value, okay, value is kind of an abstract word, right? What's a value? Well, something may be more valuable to me than it is to you because of my preferences. So we have to have some characteristics of value. And the characteristics have this little acronym, kind of cool to remember, called DUST. Okay, DUST is, the D in DUST is demand. The need or desire for possession or ownership backed by the financial means to satisfy that need. Okay, so that's the demand, the need or desire to buy. Utility, the capacity to satisfy future owners' needs and desires. How future owners can make good use of the property. That's the utility. One that's very important right now, scarcity. A finite or limited supply. Right now in a lot of areas, there are a lot of people looking for houses and there's not a lot to choose from. And so things are staying on the market for like a day or 2 days pre-coronavirus. Now, things are still okay. They're not like tanking totally, but it's a little bit slower. And then transferability. Okay. The relative ease of transfer of ownership from one person to another. And that's when we're talking about having that no clouds on the title and that kind of thing. So those are our characteristics of value. And just remember DUST: demand, utility, scarcity, transferability. And these kind of make sense. Market value. Okay, the appraisal process. Now we're kind of talking about market value. So market value, this is the most probable price a property will bring, and this is kind of interesting here. This is the key part here. In a competitive and open market, under all conditions requisite to a fair sale, the buyer and seller are acting prudently, knowledgeably, and without undue influence. Okay. So, lots of interesting things affect this when we're thinking about this. Okay. So let's say that somebody had to sell very quickly because they were moving, right? Would that necessarily be a good comp? No. Say something was an estate sale done at an auction. Is that a good comp? No. What if something was a foreclosure? No. See, that's not, because those things are not competitive, open market conditions. Buyer and seller each acting prudently, knowledgeably, and without undue influence. Here, undue pressure. So when you're looking for your comps or when you're trying to determine value, you have to make sure that the thing you're throwing in there is not, you know, the estate sale of the step parent that you couldn't stand and you just want to get rid of their house, right? So that's not one that should be considered in market value for determining the price of something else. Okay, so just kind of keep that in mind, that we have to have open and fair market conditions. Now, market value, just to remember some of these terms now, because they'll trip you up a little bit on them. Market value comes from the appraisal. Market price, what it sold for. Okay. Again, market value comes from the appraisal. Market cost, all right, is the investment by the owner. Give you an example. Cost represents past expenditures on the property, what the owner has spent on the property. One of the most common misconceptions about valuing properties that cost represents that market value, and it doesn't. So here's an example. 2 homes are identical in every way, except one is located on a street with heavy traffic, one's on a quiet residential street. The value of the one on the street with higher traffic may be less than that of the other, although the cost of each may be exactly the same. Okay, so think about that. Another example, okay, you install a swimming pool. Never a good idea for resale. Never, never, never. Most of the time it's a liability. And it costs $15,000. Okay, that's probably not going to add $15,000 to the value of your home. In fact, it may even detract from the value of your home, because a lot of people consider swimming pools to be a liability. All right. So just kind of think about that, you know, as your example. So value is always what's done by the appraiser. The price is what it's sold for. The cost is your investment. Okay, so there are lots of different forces and factors that influence value. We have social forces. That includes trends in marriage rates, divorce rates, family size, how long are people living, how many children are they having, okay? What are the social activities available in that area? So those are your social forces. Then you have economic forces. Their employment levels, property tax, interest rates, economic growth, income. That's another one. So those are all economic forces, things dealing with money. So we have things dealing with social pressures, things dealing with money forces. Then we have political. Now political, don't immediately jump and think Democrat and Republican, okay? Think about zoning, building codes, tax structures, environmental legislation. Those are all political forces. And then finally, physical forces, location, location, location. Okay. Topography, that's another one. The climate is another one. What jobs are available? Or how close is it to jobs? How close is it to public transportation? So proximity, not jobs available, because that's economic, but how close it is to the jobs or public transportation, that's physical. So those are your main forces. So social, you think about family. Economic, you think about financial. Political, think about zoning and building codes. And physical, think about location, location, location. Okay? So those are your 4 forces. All right, so now we have some basic economic principles of value. And there are 8 of these, okay? These are not difficult things. So we're going to do a little breakout group. We're going to go into 8 rooms, okay? Room number 1 will have highest and best use. Room number 2 will have substitution. 3 will have supply and demand. 4, conformity. I think you get the idea. Remember, husbands and wives, even if you're put in separate groups, go in the same group if you're in the same location, just because that will cut out on background noise. And everybody remember to mute when you are not talking. So let's do a little breakout room thing on this. We will have 8 rooms, and we'll spend about, I don't know, 5-7 minutes. And then we'll come back, have a discussion. Okay, so I'll see you then.